Over the past year, I've made dozens of videos breaking down money, investing, freedom, and simple lessons that help me build a high net worth in my 20s. And a lot of you keep asking me the same thing. Whylearn, look, I fall asleep to your COD commentaries and finance rants, but there are a lot of videos out there. Which of them are the best to learn from? So, I had a great idea that I'm going to share with all of you today. This is everything you need to know about finance, money, and investing in 2 hours. And it's going to be one big detailed finance video that's really a compilation of what I believe are the most important topics I've covered in kind of a one-stop shop finance video. Now, I know it's going to be a long one because there's a lot to cover, but in the next 2 hours, we're going to break down the following things. How being cheap in your 20s can set you free in your 30s, the basics of investing as detailed as I could make it when it comes to the principles, buying stocks, what accounts to open, things like that, why now is the time to get rich and stop waiting and start taking your money seriously. We're going to cover my personal story of how I built my own net worth to a high number. It's sitting at about $450,000 as of this video. I'm going to go over my entire portfolio, do a full portfolio reveal on the exact investments. Going to give my thoughts on dividends, why I love them, and also why I love passive income. Going to talk about the beauty of the FIRE movement, financial independence, retire early, and why reaching Coast FIRE in your 20s is a big deal. And then to conclude the video, we're going to talk about my full goal for freedom and income and my vision for the future. And this is all going to be layered over Call of Duty gameplay, just like the good old days. For those of us who played these games growing up, now we're a lot older. We have financial responsibilities. So these are some things that I think about, and I'm sure you think about as well. This video is going to be a compilation of some new commentary and some older videos. And I've edited these together to include only the most valuable parts of each video with my own commentary sprinkled in over my previous commentary. A lot of these older videos really resonated for a reason. They're detailed, they're simple, honest, and they get to the point. And these are my favorites for sure that I've made. I put a lot of work into all these videos that I make here on this channel, and I appreciate everybody's support. And I do think these tell the story well of how a normal guy like me can build wealth, and these are the knowledge and tips that I've used that I'm hoping you can use in your life as well. So consider this my early Christmas gift to you. If you're new here, this is the perfect crash course to get up to speed on everything that I get asked a lot about in the comments. If you've been here a while, think of this as a refresher video, something you can listen to while grinding, studying, driving, or falling asleep at night while thinking about money. Now, I'm not a financial advisor. I'm just a guy who learned about money the hard way and built a solid net worth in my 20s. And I want to pass this on and talk about what I wish someone taught me sooner. So without further ado, this is everything you need to know about money in your 20s in one long Call of Duty fueled video. Happy December. Thanks for being here. Feel free to skip around to each of these and decide which of these apply to you the most. Let's get right into it. So this first video is going to cover why being cheap in your 20s is so important. So I was very cheap in my 20s, and it really set me on the path to success. It enabled me to establish a huge gap between my income and my expenses. And because I kept my lifestyle so cheap, I was able to build a big cushion, and this really helped me later in my 20s when I wanted to leave my job and have more freedom. So enjoy this first video. If there's one thing I've noticed throughout my 20s, it's that so many people make this critical yet easy to avoid mistake, and it traps them in a system where they're unable to escape. Over 60% of Americans live paycheck to paycheck, unable to cover surprise expenses or break out of their predicament. So how does this happen? Once you get there, it's tough to escape, so how can we avoid this? Hey everyone, Whylearn here, and I want everyone to not just survive, but thrive in today's complex world. And today on Whylearn Wednesday, the show where you send me emails asking a question about life and I respond to them, we'll be discussing how we can thrive from a financial perspective in our 20s. So let's get right into it. Here's our question. Hello. This might be a pretty straightforward and obvious topic to anyone financially literate, but could you cover the importance of living below your means in your 20s, whether that be fresh out of college or just moved somewhere, while also maintaining a solid standard of living and quality of life? Thanks, sent from my iPhone. Well, thank you, sent from my iPhone. And I think this is a super important topic to discuss since the majority of my viewers are in their 20s, a lot of them in their early 20s. So I'm going to tell the story of my cheapness and how living below my means gave me a degree of financial freedom later in my 20s, enough to quit my job without another lined up. It is so important to be cheap when you're young, especially before you adopt major responsibilities like a house and a partner and family and things like that. I want to discuss why it might be a little tougher for our generation. It's no secret that our generation has some challenges that are unique to us. Student loans are nuts. The prices are through the roof in American university. Inflation's as worse as it's been in decades, although it's come down a little bit, but especially 2 years ago, we had historically high inflation. The job market's been a little bit brutal too for the last 2 years. So with this, it's no surprise that 60% of Americans live paycheck to paycheck. So let's go over some major expenses for your average American. First, we got a car payment between $525 for a used car and $734 for a new car. For housing, average of about $1,700 for rent or $1,800 for mortgage. discretionary spending, which is basically anything that goes beyond a need and now it's a want. So things like travel, things like entertainment, things like buying clothing that's like beyond your basic needs, things like that. So that's about $567 per month. In terms of these payments, they're pretty high. Like a car payment, I'll fight anyone to death on this. You don't need to be paying between $500 and $700 a month for a car. But the general picture here is that Americans are spending a lot of money here, like too much money. And once you settle down and have a family, your expenses skyrocket. So it's very important to pay attention to this, especially if you're before that point in your life. So I've been a cheapo most of my life. It kind of comes natural to me. I have zero inclination to spend money excessively. It's given me so much freedom and so much of my life. And a lot of that's due to, and I'm going to say it, due to my decisions. So growing up in my 20s, I've seen so many people make dumb financial decisions. Buying a $50,000 car when you're 22, making your rent $3,000 to live in a cool place when you could easily be paying $1,500. Buying fancy clothing. One of my friends spent $8,000 on a fancy new couch when mine I got from a garage sale for nothing other than the labor of moving it out of there. And a lot of people do spend on dumb and unnecessary things, and that's the key word, unnecessary. It's not needed. You can get the job done with much less. So I graduated college and lived pretty cheaply throughout college while working internships. And when I graduated, I was making a pretty good salary, about $75,000 US dollars a year, which is much more than I'd ever made in my life up to that point. So instead of balling out, which is what almost everyone did when they graduated and got that money, what did I do? Instead of going out and getting a nice apartment, I continued living in my college town in a house with 6 people, and my rent was $500 a month. The first car I bought when I graduated was about $4,800, which I paid in cash. It was old, it had 100,000 miles on it, but it was well taken care of. And before that, each of my cars cost less than $1,000 because I just wanted a car, with hundreds of thousands of miles that got me from point A to point B. And because of that, I've never had a car payment. Mostly ate at Qdoba and Chipotle and whatever single-digit meals I could make or get my hands on. And due to this, I was able to save and invest and save and invest. And then COVID hit, and I moved back in with my parents for a stint of about 2 years. And then earlier this year, 2024, I also spent another stint moving back in with my parents. Never had a car payment, and due to my living decisions, my rent payments have been minimal outside of 2 years living in the city of Milwaukee when my rent was $1,500. I was really only paying for the essentials like, food, internet, gas and electric, and eventually travel. So let's do the math here. I was making good money as an engineer, as a software engineer, and living very cheaply. I didn't have family, minimal rent, no car payment, basically just the necessities. This allowed me to save and invest tens of thousands of dollars per year throughout my 20s. And as the stock market boomed from 2019 to present day, this turned into hundreds of thousands of dollars in savings and investments throughout my 20s. I didn't do anything special. I made a solid salary and I was a cheapo. Now, can I retire? No, absolutely not. Definitely not in America, at least. But can I take surprise expenses? Yes. Can I quit my job for like a year without worrying about money, at least right now? And yes, I can. And I did. Now, I'm still a little bit stressed about money at times because I no longer have a salary, living on small paychecks from stock dividends and YouTube. But I am in a low cost of living country right now, so I'm fine for the time being. And this freedom was allowed because of the decisions I made in my 20s. Because of this lifestyle, it's given me peace of mind and freedom. I prioritized experiences over things, and I never bought dumb shit. So do I regret living like this? My first answer is hell no. Sure, maybe I missed out on some fun things, or maybe some people thought I was a loser because of how cheap or crappy my stuff was, or because I had holes in my socks, but I'm happy with how it turned out. Now, what should we be spending our money on? So I'll never say to anyone not to spend on something if it significantly increases your quality of life, your health, learning, stuff like that. Things like a good mattress, good shoes, good glasses, a gym membership, healthier food, good insurance, cool books or courses to learn things. Stuff like that is great. You want to buy stuff that improves your life. Like think of a mattress. If you have a terrible mattress, you're going to be angry the whole day because you slept bad. Like that's something you want to make. That's a good investment. Same thing with buying good shoes, so you're comfortable, good glasses, because your eyes are important, stuff like that. I would also prioritize paying for experiences, not things. Like you'll remember the adventures you went on. You'll remember visiting, that one country or going on this trip with your buddies. You're not going to really care that you bought a car that was $50,000 instead of $20,000. Excessive spending seems to be very common on things like cars, rent, and that kind of stuff. Buy a safe, reliable, used car with tens of thousands of miles. I would do hundreds of thousands of miles, that's what I bought, but You do get a lot of repairs and stuff when it comes to those older cars. But just, don't go overboard. It'll be much cheaper if you buy a used car than a new car, and it'll do the job. In terms of rent, I'd recommend to just live with roommates early on, as long as you get along with them and you live in a safe place, and don't go overboard if you don't need to. I mean, some of my friends have gotten just out of control with their crazy high rent prices just because they made money. They thought they could spend it. Now they have no savings and they're the same age as me. And also, if you decide to buy a house, get a mortgage, it can be a bad investment if you overstretch yourself and don't set aside expenses for maintaining the house. Like, all of that's on you. So a lot of people make the mistake of buying too much house, and now it becomes this liability for them, as opposed to if you're not really sure where you're going, or you don't really have like the down payment to make on a house, you might want to just continue renting in the meantime. In terms of discretionary spending, you do want to have fun. You want to, buy cool things, but just don't go overboard. Like, old iPhones still work for a while. You don't need a super crazy couch. You don't need designer clothing. Screw that stuff. Obviously, for the high earners listening to this, you have some leeway. Like, just be smart with your money. Don't spend all of it. For the common man, it's possible to accumulate money just by being cheap, and I think I'm a living example of that. I've seen people who, you make $60,000 a year, you can save way more than someone making $200,000 a year if they're spending all of it. So for the people in their 20s with no kids or family, you're really in a unique position. Your dollars invested right now, especially if you're like really early 20s, are so powerful. $1 invested could become $22 when you account for investing and compound interest. So saving while you're young should be extremely high priority. And the tragedy is that most people don't realize this until it's too late. Also, once you have family and kids, if you weren't careful at that point, you kind of might be trapped in this cycle of living paycheck to paycheck because your expenses are so high, you're providing for more than just yourself. A lot of my friends have kids, which is awesome and amazing, and I definitely want that in the next few years. It elevates your responsibility and limits the risk you can take. If you aren't in a position to save it all, you got to try your best to either cut back expenses, or if you can't do that in a healthy way, try to upskill. Learn something new. Try to figure out something where you can make a little bit more money, or maybe even a side hustle like YouTube. Here are some numbers that should scare you. Anything you spend just $19 per week on adds up to over $1,000 per year. So think of that Starbucks coffee you get, or maybe you have a fancy cocktail or a couple of beers on the weekend. That adds up. And imagine how much, if you could save thousands of dollars per year, how much that adds up over the long term. And here's another one. If you invest just $100 per month, starting at age 22, by the time you're in your 60s, this adds up to $500,000. Now, if you bump this up to $200 per month, which is, again, relatively small number to do, you have almost $1 million if we just have the same stock market returns that we've always had. What seems like a small amount of money over time adds up and compounds and just becomes huge after a while. I don't know what your guilty pleasure is, but maybe think about cutting it out or reducing it. I mean, expensive coffees, alcohol, something bigger, maybe you just don't need it. This emphasizes the importance of starting early, starting saving and investing when you're young as opposed to waiting. Most people realize this when it's too late. Yes, it's super important to live below your means. As long as you're healthy about it, you're not putting yourself in danger or your health in danger. But doing this has given me a degree of freedom, and it can for you as well. Just don't buy dumb stuff. Don't buy, expensive coffees, too much alcohol, stuff like that. So there you have it for this episode of Whylearn Wednesday. Let me know what you think, and send me any more emails with your questions. Been loving this show. Hope I can do many more, and have a good rest of your day, everyone. Okay, so this next video is the basics of investing for beginners and gamers. And this is one I took a lot of time in. I went into great detail. This video is designed for people who want to learn more about investing. They want to know just the basics of buying stocks, why investing is so important, and things like that. And this video was one of the videos that put my channel on the map. I'm proud of it. I'm probably going to do a remake of it sometime soon. But here are the most important parts of this video.
Warning. Breach detected on level 3. Initiate security protocol 115.
The financial situation of many Americans is ugly. Uglier than this Pentagon thief from Black Ops Zombies. The Pentagon thief isn't just trying to take away your weapons. He represents the overpriced subscriptions, the impulse buys, the get-rich-quick schemes trying to steal your hard-earned cash. No matter where you are in this world, he's coming for you. He's coming for your freedom. The fine people of this community don't want that. Today, we're setting up the defenses, smart investing and financial discipline to keep your money safe and working for you. We've got a loaded up video for you today. Everybody nowadays is interested in looking rich, buying a big fancy house, flexing watches, cars, and a luxury lifestyle. But on this channel, we're not like everybody else. I'm not interested in looking rich to impress a bunch of idiots. You know what I'm interested in? Actually being rich. Some of the richest people I know in my life, the normal people of Wisconsin, are not pushing Lambos, Rollies, and designer clothing. The richest normal people I know in my life, and I'm talking millions or in some cases tens of millions of dollars, they're wearing jeans, wearing a sweater, sweatshirt, and driving a Honda or a Toyota. So how do normal people accumulate wealth? It's not by buying stuff, it's investing. A lot of people have asked me to make a video on this topic and are wondering where to start, so here's my crack at it. Today's video we will discuss principles behind investing, strategies, types of accounts, stocks, historical market returns, Bitcoin, and more. I want to cover a lot, and this is kind of an information dump organized as best as I can to just present this in a straightforward way. I have a decent amount of experience investing, and it's made me quite a bit of money during the boom of the last 6 years or so. I've worked for 2 large financial firms in the last 6 years that I won't disclose their names as this video is not affiliated with them in any way. This is just to say that I've been around people talking about money for a long time. At the end of the day, we're gamers, we're strategists. So let's define the goal we want to achieve and the exact strategy to use to get there. Our main goal should be to make the gap between what you make and what you spend as big as you can and invest the rest with a long-term view. I don't care about what the market does next year or the year after. I'm talking a decades-long view. We want to use math and history and human nature in our favor. This is a longer one, and there's lots of info, so I'll do my best to explain this to someone new while balancing providing good information. So let's get this journey started. These are all just my opinions. Stocks and investments are risky, and you can lose money. Don't just blindly listen to some guy from Wisconsin on the internet. Do your own research and consult an actual professional to make decisions for your own situation. Now that we got that out of the way, let's talk about why investing is essential. We often hear this buzzword, investing, investing, investing. Well, what is investing? Investing in simple terms means putting your money into something with the goal of making it grow over time. So instead of spending your money now, you're using it to buy an asset like a stock, a bond, or real estate, and that you expect it to increase in value or generate income in the future. You can make money either through asset appreciation, which just basically means the price goes up, or through income. So think of something like a dividend where the company pays you to be an owner, or if you're a landlord and people pay you rent. Investing is a strategy of putting your money somewhere with just the expectation that you get more back in the future. It's a way for the normal man to accumulate wealth as little amounts invested over time gradually can grow to be very large amounts. There's a famous investing story about a janitor. His name was Ronald Reed, a Vermont janitor and gas station attendant who quietly amassed a fortune of over $8 million through smart investing and frugal living. Despite his modest, even low income, Ronald lived simply, saving diligently and consistently investing in high-quality dividend-paying stocks over the decades. He avoided unnecessary expenses and let the power of compound interest grow his wealth over time. His story became widely known after his death in 2014 when he donated millions of dollars to local charities and a hospital, basically demonstrating how anyone, even someone with a low-paying job, can achieve financial success through patience, discipline, and long-term investing. So how do normal people like this become millionaires? Well, there's a few ways. Let's talk about the stock market. The stock market's one of the most popular investment vehicles for millionaires. According to a 2022 study by Ramsey Solutions, 75% of millionaires invest in stocks consistently. Many millionaires invest through index funds or ETFs, individual stocks, or retirement accounts like 401ks or IRAs. Now, I'll explain all these types of accounts later in the video, so just stay with me here. First, we need to talk about inflation and why investing is essential for the common person. Many people make the mistake of having most or all of their money in cash just sitting in a bank account. This is a bad practice due to something called inflation. And you hear inflation in the news a lot, but inflation's the main reason why you need to be investing. Inflation, put simply, is when the overall prices of goods and services in an economy increase over time, and this usually happens at about 2% per year, which means that money loses its purchasing power. In simple terms, it just means that the same amount of money buys less than it did before. For example, if a loaf of bread costs $2 today and there's inflation, that might cost $2.50 or $3 in the future. And inflation just reflects how the value of money decreases as prices rise. So some inflation is a good thing. It encourages spending, which is needed to maintain a healthy economy. But it means holding large amounts of cash is a bad call in most scenarios, as you're missing out on money and actually locking in losing value over time. A prime example of inflation. In 1950, the average house price in the United States was approximately $7,000. By contrast, in the third quarter of 2024, the median home sales price had been $420,000. So an insane increase. Prices will continue to inflate, and we need to invest in stocks to beat this over the long term. So I'm 28, and I've had some success doing exactly this due to a few factors. A good market, good salary, and picking mostly safer investments and staying disciplined with investments and cheap living. Without investing, I can seriously say I'd have like half the money that I do now, with like a 6-figure lifetime gain from investments. And even better yet, my investment portfolio pays me about $600 per month in dividends for doing nothing other than being an investor in these companies. And I want that number to grow over time since it's literally money for doing nothing other than having money. As I said earlier, this is what I want our mindset to be. When you have extra money, don't think about where am I going to spend it. Think about how am I going to invest it so it becomes more money for me in the future. My overall strategy was to maintain a high salary and keep expenses as low as I can and invest the rest in the stock market. The biggest flex is not buying the expensive thing. It's knowing that you have the ability to buy said expensive thing many times over again. Again, we want to invest often. We also want to think about taxes, which can really reduce your investment gains. This mindset also involves using accounts with tax benefits, aka legally paying less taxes. Principles like diversification, not putting too many eggs in one basket or too much of your money into one thing is also important. I invest in many industries, asset types, and companies, and invest with a long-term view. When I buy a stock, I like to pretend that I won't even consider touching that money for a decade or longer. Most of the time, I invest based on value, not speculation. I want to understand what I'm buying and ideally want something that's making money for me in the future. I don't get fancy. I simply purchase stocks, ETFs, mutual funds. So for this next part, little disclaimer, there's some boring yet beautiful math here, but it's crucial to understand how investing works, so I'll explain as best as I can. There's a formula here that runs our life, whether we know it or not, and here it is. This is the formula for compound interest. Now, I'm not going to bore you with the details of the math, but this equation is a predictor of how much money you can gain from investments. Know that arguably the most important and exponential variable in this equation is time. Now, what do I mean by exponential? In simpler terms, if you start younger, it is much easier to get rich and you have to contribute much less because your money has a longer time horizon to grow and grow. The longer the time you have invested, the easier it is to accumulate money. Now, Whylearn, why are you showing me these stupid charts? Well, here's why. Here's the return of the United States stock market over time. This has historically been about 7 to 10% per year. So as long as America is growing and prosperous, the market should still continue to go up over time. Here's a chart of the returns per year. Notice the numbers are compressed at the top. If the chart was actually expanded outwards, it would look a lot like that exponential formula. Here's a different chart showing the annual returns each year in a bar graph. You'll notice that the positive years far outweigh the negative years. There's some good ones, some bad ones, but from the beginning to the end, it usually goes up about 10% per year over time. Now, do some math for yourself. You can assume a 7 to 10% return per year on average, and this should make you some good money over the long term. Now, past performance is not an indicator of future success, and there's no guarantee we'll have these same returns over the next 100 years that came before us, but I like betting on America. I wouldn't bet against it. The more money you have at play, the more you accumulate as it grows. For example, if you have $1,000 invested and the market goes up 10%, you made $100. But if you have $10,000, you made $1,000. And if you have $100,000 or even $1 million invested, you're making some legit money just from the stock market. It can go up or down on a yearly basis, but over time, it trends upward. Imagine if you had $100,000 invested last year in 2023. The stock market went up 16%, which means that your investment gain would have been $16,000 for doing nothing other than investing. It can also go down like it has a few times in my life, but overall, it trends upward. This is why the rich get richer. It's just math. Take advantage of investing while young. It means you get more opportunity for your money to grow. You'd rather be a 20-year-old investing $80 a month than a 35-year-old who just started to invest $500 a month. Plus, when you're young, there's less expenses, life's cheaper, and it's socially acceptable to just be a cheapo. But if you're 30 and you're still living with your parents, people might ask what the hell you've been doing all these years. But Whylearn, inflation's going to eat away, and $1 million today might not be $1 million in 40 years. Well, you're right. $1 million today will definitely not be $1 million in 40 years, but would you rather have cash? Absolutely not. Investing's a way to beat inflation over the long term. Like, you don't care what the price of McDonald's is if it increases if you own a portion of McDonald's. Use stocks to beat inflation. Okay, so now we know that we're taking a long-term view to invest in a nice and stable asset that goes up over time. What mistakes could I possibly make? Well, many. Stocks go down a lot, and it's human nature to sell to avoid losses. When everyone else is selling and the prices are lower, this is exactly when you should be buying. That's how I profited off of a lot of these downswings. It's inevitable that stocks will lose value from time to time. Think of the stock market like a grocery store sale. If you walk into a grocery store and everything's 30% off, you'd be like, hell yeah. But for some reason with stocks, everybody freaks out and nobody wants to buy them. Treat it similarly. When prices drop, it's an opportunity to buy more stocks on sale. These downturns allow disciplined investors to accumulate shares at lower prices, setting the stage for greater gains when the market rebounds. They say the stock market is just a tool for transferring wealth from the impatient to the patient. Use that quote wisely. I'm not going to get into the details of options trading, as it can be a complex process with a lot more math and risk involved. Options and leverage allows investors to control more assets with less money, but they come with higher risks. You can purchase a contract or a right to buy a large amount of someone's shares, basically trading with debt or leveraged money, aka money that's not yours. It means you're amplifying your risk with other people's money. This can be great if it works out for you, but awful if it doesn't, as you might owe a lot more money to someone than you'd be comfortable with. You can bet on fancy things like a stock to go down in 3 days or volatility to remain stable and much more. And it often involves deeper and much more complex strategy than normal people should worry about. As a rule of thumb, I avoid trading with money that's not mine. I don't use margin, I don't use debt. I stay away from all that so I can sleep well at night. Stock options can be given to you by an employer with a publicly traded company, and this is fine, but I haven't gone out of my way to trade options. Unless you really know what you're doing, stay away from this. Know the difference between gambling and investing, and be an investor. I don't believe in short-term investments. Some people trade for a few minutes, for a day, a week. To me, this seems more like gambling than investing. There are entire firms of people with PhDs in mathematics and economics from Harvard and Yale working on short-term trading models who still have issues succeeding. So do you really think little old you can beat them over the long term? There's just too many variables. Like, we don't know what's going to happen tomorrow. We don't know what's going to happen in the market in the next 5 minutes. So why bet on the outcome? I recall when I began investing in 2019, Trump was in the peak of his tariff war with China, and a simple tweet that he'd send at 1 p.m. on a Tuesday could send the market in a frenzy. So why try to predict same-day things when one tiny event could ruin it all? Betting on earnings, week-to-week fluctuations might be a bad idea, and I've got burned a few times doing this. My most recent fail with gambling instead of investing was trying to buy Spirit Airlines, just gambling on the fact it wouldn't go bankrupt, and that did not work out for me. So know the difference between gambling and investing. Gambling means that you're going to the casino, and mathematically you know that it's a bad use of your money. Investing means owning the casino, where you know it's rigged in your favor. Anytime someone says that you can get a huge return and be rich in 1 year with this NFT or this crypto that's going to blow up tomorrow, your radar should be buzzing. You are only going to make someone else rich quickly by participating in these games, likely involving a high amount of risk that's just not worth it. Can it happen? Yes. But is it likely to happen? No. You want to know what is more likely to happen? The market to slowly go up about 10% over the long haul. If an actual tool came out that could guarantee a 50% return on investment monthly, it would break the entire financial system. The risk has to be somewhere, so stay away from people promising to make you millions next month. Next, let's go over the high-level steps in a plan to start investing. This is a hybrid of many systems inspired by people like Dave Ramsey, Warren Buffett, and more. Now, this is only for investments, does not include debt. Any high-interest debt should be prioritized very highly in this list. So step 1 would be having 3 to 6 months of living expenses or some sort of emergency plan saved up. This is otherwise known as the shit happens fund. You never know when a surprise expense comes up. You need to repair something in your car, or something in your house breaks, maybe your refrigerator needs a repair. Stuff like that happens all the time and needs to have a plan so you're not stressed out when unexpected expenses come up. Step 2 would be to invest in a 401k, ideally with a company match or a company HSA if available. Step 3 would be to invest in a Roth IRA for tax-free growth. Both of those are just basically tax-advantaged accounts I'll get into later. Number 4 would be a taxable brokerage account once you've exhausted options 2 and 3. And step 5, if you want, would be alternative assets that are a little bit riskier, maybe a little bit smaller percentage of your portfolio, something like crypto or collectibles. Now, I'll talk more about all these accounts in more detail in the next section, but my strategy was to buy mostly safer things like Triple Q, VIG, VYM, SPY, VTSX, and bigger staples like Amazon, McDonald's, and other things. All of those are just symbols for ETFs or index funds. Now, I'd use a small amount of my money, less than 5% of my portfolio, for riskier things like Bitcoin or collectibles. I'd invest more during downturns and otherwise consistently each month put a little bit of my paycheck into these investments. I'd reinvest dividends, and I have faith that the markets will go up over time. Now, let's get into some of the types of accounts that I use. First is a checking account, which is a simple bank account to just receive checks, receive your money, transfer money, pay credit cards, which you should only use if you can pay them off in full every month. And I'd keep enough money here to just buy month-to-month items or for an emergency fund. Nothing crazy, very low yield. A savings account can also be used to park money for a little bit of time to have a little bit more yield, like a couple of percentage points, maybe for an emergency fund. Next would be a 401k or a traditional IRA. So this is a retirement account usually given to you through your employer, which means that you don't pay taxes at the time of earning the money, and it goes into this account, and this non-taxed money grows with the stock market. Usually gets invested into some mutual fund or whatever you choose, and then you pay taxes when you withdraw it. So this is a retirement account, which means it will be penalized. It has contribution limits that I'll put on the screen, and oftentimes with an employer match, which is just free money. That basically means if you invest 5% into a 401k, the company might match that and give you 5% more. I had mine through Empower and Vanguard. The next one's my personal favorite, which is a Roth IRA. This must be set up manually. I did mine with Charles Schwab, and the money that goes in's already been taxed, so you just transfer the money over and it grows tax-free. That's why there's a low limit on it and also an income limit. So that's how you know it's a cheat code, when the IRS totally limits what you can do with it. So imagine if you have 500,000 in a 401k, you're going to pay taxes on at least 100,000 of that. But if you have it in a Roth IRA, there are no taxes. So that's why I love it. Next account that I use is an HSA. This is a health savings account. I believe you need to be part of a high deductible health insurance plan, either through a marketplace or through your employer to be able to have this. But basically, it's kind of combines a little bit of the 401k and the Roth IRA. It's tax free at the time of earning it when it goes into the account, and then as long as it's used for a medical expense, it's tax-free out. So it's a triple tax benefit, which is very, very useful account. And we all have medical expenses as well. So this is definitely one I'd recommend. Now, if you max out all the above options that are tax advantaged, the next is to just buy individual stocks in a taxable brokerage account. So that means the money that goes into it's already been taxed, and you must be taxed afterwards on things like capital gains and dividends. This has grown to be my biggest account, mainly due to income limitations on the other ones. And there's some other accounts too, obviously, that I haven't gotten into. These are just what I've used. There's others like a Roth 401k, an FSA, and a 529, and these are all just used for a variety of situations. So why does account type matter? And the answer is taxes and fees. Taxes can eat away at your gains. For example, if you have $1 million in a 401k when you retire, congratulations, but it still must be taxed, and you'll likely be paying a few $100,000 in taxes. In a Roth, no taxes. So you want to utilize the tools that we have here in America. I try to legally avoid paying taxes through tax-advantaged accounts. You have to pay taxes on things in a tax scenario such as an individual brokerage. This can be either dividends, so when you get payments from the company that you have to do taxes on that at the end of the year, as well as capital gains, which just means you buy a stock at a certain price, you sell it at a higher price, and that difference you have to pay taxes on. Eventually, with investments, when you're get more into the investing world, you'll no longer get a tax refund. You'll actually be paying the IRS back money that you gain from your investments. So let's get into some of the concrete stuff here. How to open an account. Go onto a site of a well-known broker, and I prefer the big guys. So think like Charles Schwab, E-Trade, TD, Ameritrade, stuff like that. And select an account type, enter your info, and they will ask for your sensitive information. Don't be alarmed, and create an account. Once it's created, you'll need to link your bank account to transfer money in. Do not invest off of debt or credit. Use your own money, okay? Transfer your own money in, damn it. So now let's talk about how to buy a stock or an ETF. You have some options here. The most common ones would be a stock or an ETF, which is either a publicly traded company or a grouping of publicly traded companies. So they have stock tickers, which is just basically a code or an abbreviation for that stock. So for example, Amazon is AMZN, and you can easily look these up on Google. So you can also buy an ETF, which is an exchange traded fund, which is basically just a mix of companies, which is a little bit less risk. So they're all traded on an exchange, usually a place or a market where people come together to buy and sell stocks. The New York Stock Exchange is the most well-known one. So stocks will likely need to be purchased during normal trading hours if you do a market order, otherwise off-hours trading. So open hours outside of holidays are 9:30 a.m. Eastern Time to 4 p.m. Eastern Time. So here's a look at an example order screen. You select the symbol, which is just the stock ticker, so you can look that up on Google. Strategy would be stock or ETF. An action would be either to buy or sell in most scenarios. You select the quantity. Notice in the upper right, you have the share price, which means that if you buy 8 shares at $500, this would be about a $4,000 purchase. It's just an example. If the stock pays dividends, you can usually check to reinvest dividends, which I would do that if the stock offers dividends. The order type, I like to use market, but you can use limit if you need to, which just basically means you set the price of what you want to buy it at, the timing for how long you want the order to be open. And this, just the way it is laid out on the screen, you would be buying at the current market price. Go through the ticket, select all that stuff, and then once you hit submit order, then you wait for them to confirm that the order was filled, and then congratulations, you're an investor. Now, which stocks do we buy and for how long? This can be a very complex and debated topic, but I would say safe, stable companies, lower PE, good growth, a history and track record of success, or a super innovative product. I'd stick to safer stuff for strong companies. Some of the ETFs I like would be the QQQ, which is just basically a collection of the biggest tech companies in America, or SPY, which basically tracks the American market, the S&P 500. Some index funds I own, especially in my retirement, would be VTTSX, which I believe is a index fund or mutual fund. I don't really remember, but that's basically like an account that for people retiring in 2060. If you're more interested in individual stocks, they're more risky, but they can be good as well. And there's a lot of theory as to which ones to buy. There's value investing. There's all sorts of things you can do there. But I prefer to be a value investor. Like, think of good technology or things you may know about and try to understand it and research into the company. See if you can find some good deals. Now, how long to hold? This is a loaded question. I would say ideally a very long time horizon. I hope you're seeing my point here. Mathematically, the longer you hold on to stocks, the better off they do. Let's look at this chart. If you hold stocks for less than a year, you basically have like a 35 to 40% chance of losing money. But if you hold a stock 10 years, that odds reduces to about 12%. And if you hold a stock for 20 years, or especially if it's an ETF or something that represents America, your odds of losing money are slim to none. Use math in your favor here. The longer you hold on to stocks, the more high of a probability it is to go up. So let's talk about dividends. Dividends are my favorite passive income. Some companies pay out a portion of their earnings back to shareholders. This is called dividends. I like this because it shows company stability. It gives you a little bit extra income. So how can you retire sustainably? Well, you'd usually have like a mix of a 401k and some sort of investment portfolio with a dividend yield. So if you have $1 million and the dividend yield is 3%, you'd be making around $30,000 more just for doing nothing. That's a lifetime goal of mine, and I love loading up on dividend stocks. Now, hopefully I've convinced you to buy safer stuff for a long time horizon, using tax benefits, looking mostly into ETFs or index funds, and maybe dabbling in individual stocks if you're interested in doing the research. But it's important to remember that risk is always present and stock dips are common. For example, a correction, which is when the market drops 10% or more from a recent high, occurs every 1 to 2 years. Recessions usually happen every 5 to 10 years, and this is a 20% decline in stocks, followed by a decline in GDP. Depressions are much rarer in a severe economic event, but they're still possible as well. We remember back to the Great Depression in the 1930s as an example where the stock market dropped, I believe, 90% from its high, which is nuts. So these are rare, but serve as just a reminder that the stocks bounce back. They always come back. Remember the grocery store example. If stock prices are lower, go shopping. I want us to be dollar cost averaging, which just means investing a fixed amount of money on a regular basis and maybe even more if stocks are down. The market's overall trend has been upwards over the long terms. Corrections, recessions, and even rare depressions are just temporary setbacks in a much larger growth story. By staying invested and consistently adding to your portfolio and not panic selling, you can take advantage of the long-term growth and avoid emotional decision making. Patience is key. Successful investing is about time in the market, not timing the market. Let's talk about some other asset classes, such as houses and cars. In most cases, cars are a depreciating asset, unless it's a super old, collectible, or rare car. But be cheap, as cars are basically a guarantee to lose money. You have to kind of be a car guy to derive enjoyment from this. Houses can be a good investment, especially if you're in an up-and-coming area and you'll stay in that area for a longer period of time, usually 10 years or more, and you can make an adequate down payment, and it's a mortgage you can afford. However, one thing I've noticed is that many people are just too eager to buy a house and often bite into a bad situation too early. There seems to be an American obsession with, I gotta buy a house, I need to own a house. It's the status symbol. But in my mind, there's no rush to own a house, especially if you're investing your money in other things like stocks. So just be careful with that, do your research, and make sure you make a wise decision that's within your means. Now let's talk about the fancy buzzword, crypto and other assets. And my advice for these is to be careful. These can be tricky. In one way, they're a speculative asset, which means you're buying something that's not producing an income or being productive, just banking that someone else will buy it and pay more for it in the future. For example, if you're buying a share of McDonald's, this is a productive asset. McDonald's is a company that's generating monetary value in the world and pays you back in dividends each time someone buys McDouble. Gold, Bitcoin, collectibles are not income-producing assets. It's a totally different class. Digital assets like Bitcoin are highly volatile and speculative. They may seem intriguing, and there's a case to be made for these use cases and viability of Bitcoin as a store of value and a transactional currency. But I see too many young guys putting all their money in this with the hopes to get rich quick. I would say to be very careful. Most people pushing crypto and Bitcoin probably couldn't even tell you what cryptography is or what the blockchain even is. And if you're one of those people with all your money in crypto and you can't even tell me the basics of crypto and blockchain and the ledger, you don't understand what you're buying straight up, and you should probably think twice before blindly buying things. Another example of an asset is gold. It's traditionally thought as a safe haven asset that holds value over time, especially during like economic uncertainty, but it doesn't generate any income like dividends or rent, so a lot of people say it shouldn't be a huge part of your portfolio. I'm not telling you whether or not you should buy any of these. I have a little bit of all three, but be careful with them, especially crypto and collectibles, as they're definitely riskier. So that was a big Whylearn brain dump for you guys, and I hope you found something useful out of it. Hope you enjoyed it. I hope I got my point across that we should strive to be smart, disciplined investors who don't overreact. We take a long time horizon and invest in things we understand and are confident that are going to go up over the long haul. A little bit each month adds up, so start now. So much to talk about, and I want to expand on these, but here it is. Let me know what you think. Remember to be careful, take a long-term view, and get rich slowly. This next video in this series is called You're Running Out of Time to Get Rich. And this really covers something that I see that happens with people way too often nowadays, is that they delay investing, which is very dangerous because when you're in your 20s, you have a big advantage, and that's that money's more valuable for you because of the long time horizon. The earlier you start investing, the better, and let's get into why in this video. You're running out of time. I want to spell this out as clear as I can for everyone because I see far too many young people in their 20s making this exact mistake, and it's going to cost them later in their life. This video is for the guy who's in his 20s and maybe hasn't started taking money seriously yet. It's still an afterthought. Maybe you've been prioritizing and buying other things, and I get it. You're young. You're figuring out a lot of stuff. Maybe instead of investing that extra money you got, you go and upgrade your car, you go and upgrade your phone or computer. Or maybe you just leave your money in cash in a bank account because you think it's the safest thing to do. You may think you have time, like you have your whole life to figure out money and investing, but you don't. In fact, if you aren't getting on top of this thing as early as possible, you're running out of time to be rich, and I'm going to tell you why in this video. This reminds me of one of my all-time favorite investing quotes by businessman Jim Rohn. He says, everything is risky. If you think investing is risky, wait until they hand you the tab for not investing. Today I'm going to show you the tab, the true cost of not investing if you wait too long. Like after all, what could happen if you do decide to wait to invest until you're in your 30s, your 40s, your 50s? If you're lax in how you approach money, it's very likely that later in your life, instead of your dollars working for you and giving you income, you'll have to continue to work for your dollars and work longer than you'll like. The only regret I have about my investing journey so far is that I didn't start even sooner, and I started at 22. So if you're lucky enough to be watching this and be younger than that, like you have an opportunity before you, and please pay attention to this. To me, it's very sad when I see people, and many times people close to me in my life are in their mid-20s, late 20s, early 30s saying stuff like, oh, I got time. I don't need to worry about this investing thing yet. I'll figure out money later. Like I can start in my 30s, maybe when I have more responsibilities, and then I can take money seriously. But for now, I'll just have fun. And I just shake my head when I see this line of thinking, because by doing this, you're actually throwing away your prime advantage in investing, and that's time. And it could be costing you hundreds of thousands of dollars over your life. There seem to be two kinds of people in life. Those who prioritize spending money and those who prioritize investing money. Normal people can get rich if you start young. I have people close to me in my life who I would say are making bad financial decisions. Maybe they have a good cushion of money, but they're scared to invest it and they keep it in cash instead of investing it in 2020, 2021 and beyond. Maybe every time they get a bonus, they think about how can I spend this instead of how can I invest it. And man, even though that we may have made similar salaries throughout our lives, our financial standing now is vastly different even 6 short years later. Like I'm talking 6-figure differences simply because I just started investing so young and the market's done so well since I started. I've invested aggressively in my life, almost to the point of overdoing it, and my thinking was literally like, how can I get an extra $50 into the markets? I remember during COVID, I was selling some of my old baseball and football cards on eBay just to get an extra $20, $50, $100 in my pocket to be able to put into the stock market. It took me some time to build this thing up, but it has given me so much. And I'm damn proud to say I have a nice army of dollars working for me now. I own this asset of stocks, ETFs, and investments that not only could I sell it for its face value, but it pays me over $600 per month just for owning it in dividends. And how did I get there? It wasn't overnight, but it was by doing a little bit over time for about 6 years. I don't have to touch my investments, and they'll likely grow into millions just by themselves. And I do zero work on this for $600 per month. And that's the beautiful definition of dollars working for me. It's like an employee that goes out and works for me around the clock, bringing me money, about $20 per day, even in my sleep, no matter what I do. And I want that for you. Let me show you the brutal cost of waiting to invest. So we're going to do a very simplified calculation, one that includes inflation as well. So let's say your name's Jim and you're 20 years old, you're in college, you're working part-time, but you decide you want to start investing. So you decide to start investing $200 per month, which is a very reasonable amount of money that I believe that normal people should be able to come up with. Now we have Dwight. He just turned 30 and he's getting married soon, and he figures, oh, I should probably start taking money seriously now, right? So he starts investing at 30, the same amount, $200 per month. So we're going to make a few just standard assumptions. We're going to assume a 10% return, which is basically matches the historical return of the S&P 500. And with inflation, it's about 7 or 8%. We're also going to factor in a 2% inflation rate. And as you get older, it's also fair to factor in that you'll be investing a little bit more over time as well, about 2%. So again, all of these are very normal assumptions. Now at retirement age, at age 65, how much money do you think they each have? So Jim started at age 20 and Dwight started at age 30. Just a 10-year difference, and there's still lots of time, right? So we can assume Jim's going to have more money, but the question is how much money? So if you break it down, you do the math, it's a big difference. Jim will retire with about $2.2 million and almost $1 million adjusted for inflation. And just because he waited a little bit, poor Dwight has only $800,000, and that's like literally over $1 million less, and about $410,000 if you adjust it for inflation. So no matter what way you slice it, inflation, no inflation, Dwight's now kicking himself because for those 10 years, it literally cost him hundreds of thousands of dollars, even over $1 million, because he wasted the best asset of his life, and that's time. Just to catch up to Jim and have $2 million by retirement, he has to invest much, much more, about $500 or $600 per month instead of the measly $200. And I don't even want to talk about what you have to do if you wait till your 40s to start. You're going to be looking at $1,500 plus of investing per month. So at a certain point, it becomes much more difficult to become a millionaire if you wait so long to start, because instead of investing hundreds of dollars per month to become a millionaire, it turns into investing thousands per month to make it instead if you just wait. Instead of making it really hard on yourself to get rich, if you start young, you can just make it easy for yourself. And as you can see, the total amount you put in is just a tiny amount compared to what you have at the end because you let your money compound for so long. This is obviously a very oversimplified example, like the market fluctuates a lot. Sometimes it goes up 10%, sometimes it goes down 15%, sometimes it goes up 26%. Like it varies a lot, but overall, on average, over time, it's been about 10% per year. This, gentlemen, is how people trap themselves, and they don't even know it. Because by waiting for just 5-10 years, you're giving away your biggest advantage in investing, and that's time. You get to a point in your 30s, your 40s, where you have more responsibilities, and although you're likely earning more, it's just much harder to invest larger amounts to keep up with compounding. Now, if you're 30, 40 watching this, like it's better to start now than never, but it just would have been much easier if you did this when you were younger. And good luck investing more when you have just so many more expenses. Like you're likely maintaining a house, you'd have more bills, maybe more health expenses, and you might have a family to support. People really do have it backwards. They say they're going to wait till they're older to figure out money, except when they're older, they've already given away their biggest advantage. This is the tab of waiting to invest, and it might cost you not only your financial freedom, but you could find yourself trapped in this cycle without an asset, without an army of dollars paying you. And now, unless you can just force your way back into the game by earning a really high income, you could be stuck. And that's the cold reality. Like you're locked into working for a long time, forcing yourself into work longer than you would have liked, or maybe even putting your retirement in jeopardy. And it's sad, but it's true. Like I don't want people making these mistakes when they could have been investing when they were younger and they just, ignored it. Now, people always say, oh, but Whylearn, the market's going to crash. It's about to crash right now, bro. And then what I say to that is, I agree with you. It's basically inevitable that it's going to crash again. It could crash tomorrow, could crash in 1 year, could crash in 10 years. And you're right. But do you know enough about the markets to time it? What if it goes up 40% more and then it crashes 15%? Like, I guess you could wait for it to crash, but what's the risk in that? What's the alternative? Cash is getting eaten away by inflation, plus the big opportunity cost if the market continues to go up as it has been. It's the safer thing in the short term, but historically definitely not in the long term. Something like gold is also seen as another safety asset, but it lags behind stocks since companies are providing value and producing income over the long term, whereas gold is just a store of value. It's not producing anything. It's only really makes sense to buy before a recession, but we don't even know when that is at the same time. And then we have crypto, which is extremely volatile and just as risky, if not riskier than stocks. And even something as big as Bitcoin has seen 70% crashes at many times throughout its cycle. Then we have real estate, which has underperformed the stock market gains by most available metrics. And that doesn't even factor in all the repair work you have to do. So the bottom line here is everything's risky, so you just have to choose your risk. And everyone's situation's different, right? And in your case, sometimes holding cash or making alternative investment is a good call. And I'm definitely not making professional recommendations. Like, do your own research. For me, I found the stock market to be the best vehicle for me. All available data shows it's better to invest now and not try to time the market so you can get your dollars working for you over a long time horizon. Here's a graph that I think perfectly summarizes why you need to just ignore the media and ignore the noise, even just in the last 15 years. Everyone says all the time, the market's crashing, and then it just keeps running as American businesses get better, more productive, making better products. You can see every single year there's articles coming out that say the market's going to crash and the line keeps going up and to the right. Now, is it guaranteed to keep going this way? No. It could obviously crash, but this is the data we have to work with. Here is where I started my journey, right around the beginning of 2019. And the S&P has over doubled, and I've also invested during several big stock market crashes. If I listened to the experts and pulled all my money out, I'd have so much less than I do now. Now, there's no denying there are big risks right now. There's global conflict, global tensions, like there could be another virus at some point, or there could be some large-scale financial collapse or bubble burst similar to 2008. But there's things going for the economy too, mainly the evolution of technology that's multiplying productivity at scales we've never seen. I'm trained to handle these drops by now. Like, they're not all bad. And if the stocks go down, you can keep investing at these cheaper prices. I mean, even the last few days, yeah, the stock market's been down a little bit. And I've seen people in the comments asking me, oh, what do I think about this crash? It's like, first of all, dude, if you think this 5-7% correction's a crash, you haven't seen anything yet. I personally experienced much worse. And if you panic sell during a crisis, just know that I'm happily buying your shares at a discount. The stock market is a true test of your emotional discipline. As Warren Buffett once said, the stock market's just a tool for transferring money from the impatient to the patient. Stocks are a little bit high right now and maybe even overvalued historically based on a few indicators, and corrections, crashes, and recessions happen at any time. If you watch this video and then you make your first investment and then we experience a crash, don't get mad at me. That's part of the game. I'm telling you that this is going to happen and you need to be ready for it. Stocks are risky, but if anything, you should be excited about crashes and not sell. Like, the market's dipping a little bit right now, and that's okay. Because if anything, you could buy more than you could before. Because I really don't care about a one-day outlook. Like, one-day outlooks don't bother me. I care more about the 1-year outlook, the 2-year outlook, the 10-year outlook. And if stocks keep going down and you're not paying attention, it could cost you, because taking advantage of stock market downturns has changed the game for me and given me almost a generational opportunity. So you might be asking yourself, what should I be investing in? And as always, this is not financial advice. I'm just a guy from Wisconsin, not a professional advisor. Do your own research and don't listen to idiots on the internet like me. Here's what's worked for me. The vast majority of my portfolio is in safe ETFs and funds that track the overall American stock market, with some individual stocks and small amount of crypto sprinkled in. I like ETFs more than stocks just because some stocks, if they could have bad things happen, they could even go to zero, and ETFs protect against individual stock fluctuations. For most people, ETFs should be just fine. So I have SCHD for dividends, SPY for the S&P 500, QQQ for technology exposure, VIG for dividend appreciation, and more. And I hold these in a few different types of accounts, from 401ks to Roth IRAs to HSAs to individual taxable brokerage accounts as well. And when I buy a stock, it's not a couple of months thing. I literally pretend that I'm bought in for decades. Like, the vast majority of my positions are long-term that I've held for years. And because of my patience, I've been rewarded with my gains. That's the mentality, and you need that, because the longer that you hold a stock, it increases the probability of success. And if you don't have spare cash to invest right now, that's fine, because then what you need to be doing is investing in yourself. Invest in you, because then you can finally get an income to be able to do investing like this and set yourself up for the future. So I took advantage of several tax advantage vehicles, and I bought into nice and stable and long-term things. No get-rich-quick schemes, nothing like that. Thanks everyone for watching. Please take money seriously, take this stuff seriously, and then you'll thank yourself in the future. So catch everyone later, and we'll see you in the next one. So this next video really is more of a personal one. It's my personal story of how I went from nothing to a multi-six-figure net worth, about 420,000 at the time this video was recorded. Right now we're sitting at about 450, 460,000. So if you want to know everything from what jobs I had to my education to, my net worth at each phase of my life, here's a good video to follow. Enjoy. Okay, so I'm getting smoked in the stock market right now. And to prove it to you, the title of this video has changed drastically in the last week. If I made this video even a month ago, the title would have been How I Got to a $430,000 Net Worth by age 28. But that's changed now. So this video is going to cover how I built my net worth from zero to about $400,000 by age 28. And honestly, after this recording, I don't know exactly where it is. It's a very volatile day. Could be in the high 380s, 390s, could be 410. Like, it changes every hour. Okay, so quick update. Apparently the video's already outdated since I recorded it this morning because as of Tuesday, April 8th, we had another crash. So I ran the numbers. My net worth's actually around 380K, down from 430, which is absolutely crazy. And also that includes me adding an extra 30,000 to it from my work bonus last month. So I've been getting killed. But one thing's certain is that this is a crash now and it's going to go down in history. I was a little bit torn on making this video because it is a very transparent video, but given what's going on, it just feels like the perfect time. I'm only sharing this for transparency. This is not to brag. I'm making this to show you something about what you can do and what a realistic path of building wealth looks like. I don't know what's going to happen in the near term in the stock market, but I do know what these crashes have done for me in the past. So today I'm going to explain how the last two stock market crashes helped me build my net worth to over 400 G's by my late 20s. And my actions during these crises is a big reason why I could do the things I'm doing now. So here we are. This $400,000 net worth is a combination of tax-advantaged accounts, individual taxable brokerage accounts, checking accounts, and a small amount of crypto. If I was new to investing, I'd for sure be freaking out right about now. I mean, this was me in 2020 and in 2022. But I've been through these exact emotions a couple of times now, and this has enabled me to be much calmer right now. And maybe even part of me is excited given how these last two crashes panned out for me and enabled me to just scoop up a bunch of shares at low prices. I'm seeing the same exact behavior that we saw last time. Everyone get out, it's over, everything's done. People tend to buy when it was high and then sell when it's lower, which, believe it or not, is not what we should be doing. People just tend to overreact to things. It's human nature. Building this portfolio has allowed me so many things in my life: to quit my job, to travel the world, to deploy the money to get passive income, and give me the opportunity to make entrepreneurship work. So I'm going to talk about each step of the way to get to this point, my university, my career, all investment vehicles I used at each step, and how a few crises in the stock market just helped me blast off to the next level. I also want to discuss some mistakes I made and future goals given the current climate. I want to show you what your finances could look like if you roughly follow this strategy or steps. Obviously, there's no guarantees, but I'm just going to provide my example. As always, this is not financial advice. This is just a story on how I built my net worth. And I talk about this a lot in my videos, but I just want to show how normal people can do this. Like, I'm just a guy from Wisconsin. I went to university, got a 9-to-5 job, lived frugally, and invested. Very normal path. I don't believe I'm extraordinarily talented or smart, and nothing super crazy happened in my life. But I did work hard. I'd say there were three main reasons why this worked if you had to summarize it in one sentence. I had a high income, I lived very cheaply in my 20s, and I invested the whole time, especially during downturns. Let me know how much money you've lost on paper during this crash. For me, it's in excess of 40 to 50,000 when you add it all up so far. So it's definitely not a good time. So first, I want to talk about why should we be doing this? Why should we care about our financial situation? And here's why. I've said this before too, but it's very sad for me when I see people in their early 20s, early 30s saying like, oh, I got time. I don't need to worry about investing. I'd shake my head every time because you're washing away your biggest asset in investing, and that's time, and it could be costing you over your life. I took advantage of this from an early age. I started investing at age 22, and it's provided me with many things. Number one, a safety cushion. If stuff goes wrong, I can comfortably pay for it. I can afford that surprise car fix, that medical bill, or more. And it just helps me stress less and sleep well at night, knowing I can cover unexpected things that come up, which do happen all the time. This also provides me with an income. My money is working for me. I have a lot of it in dividend ETFs like SCHD to give me income during uncertain times. It's an income producing asset that's working for me around the clock, even when I'm not working. And I make about $21 a day, every single day, and an average of over $600 a month, no matter what I'm doing that month. And that number is continually growing. And then this is the next part, and this is probably my favorite part of building a high net worth, is that I don't think of money as like, what can I buy with this? I think of each dollar as a unit of freedom to buy my time and freedom back. If you have money, you just have more options with what to do with your life. And more importantly, you have freedom and you can make decisions and be pickier with your opportunities. With 400 grand, like obviously I can't retire on that if I want to live in America, but here's what I can do. At this level, if you don't like your job, you can leave. If you want to go travel, no worries, you can do it. I got to a spot at age 28 where I wanted to travel with my girlfriend and pursue entrepreneurship, so I did it. And if I wasn't intentional with my money in my 20s, I would not have had that option and would likely be stuck in a less than ideal situation right now. I intentionally keep my overhead, very low in my life. I don't have a mortgage, I don't have any debts, I don't have long-term rent. And it's not that I'm against these things, it's just my situation in life, this doesn't fit me yet. Those will all come at a later time. And 400,000 isn't the end game, but it's a pretty damn good start that puts me near the top percentile for my age group. So I've reached what is called coast fire, which just means that I don't need to contribute any more money into my portfolio and I'll be able to retire as a multimillionaire, assuming that the market at least does okay and continues to generate a 7 to 10% return. And of course, no big surprises come up. But I'm reinvesting $600 a month into my portfolio through dividends, and it's just going to continue to grow itself into millions of dollars by my 60s if I literally just break even for the rest of my life. My work in my 20s really set me up for life, assuming I don't squander this opportunity or do something crazy or idiotic. I believe you can do this. I can't guarantee, the future or the same results, but I'm a believer in technology and innovation in both the American and international stock markets, and that's where I'm investing in. You got to decide what makes sense for you. So just one note, I do want to talk about hard work versus luck in investing and in life, because most accomplishments in our lives are some combination of skills and luck. Like, it would be foolish to deny that luck is always a factor in our lives, and I was lucky that these downturns happen and lucky that they bounce back. And I always think back to this story of late legendary billionaire investor Charlie Munger. He said when he was a kid, he was playing in his yard with his friend, and a rabid dog got loose and ended up lunging at him and his friend. It ended up attacking his friend, who eventually died right after due to the injuries and infections. It was basically pure luck that the dog chose to attack his friend and not him, and that allowed him to live and become successful and become a billionaire. And that was nothing of his own. That was just pure luck. I've had skills and luck work in my favor in many ways. The skills being, I've always worked hard. I took advantage of the opportunities given to me. I kept learning. I always wanted to improve my knowledge, my communication skills, and I believe life is a process of continual improvement. I went from minimum wage jobs to smaller paying internships, then bigger paying internships, then my salary for $70K, then my first full-time job, and then I ended up around $140, $150K when I left. And that's where hard work played a role, because I was continuously making myself more valuable. And the next huge part was that I was a disciplined investor. I didn't chase get-rich-quick schemes, and I invested monthly consistently. That's also not luck. Now, the part where I am very, very lucky is, number one, the country I was born in. I believe the USA is the easiest country to get wealthy in my opinion. The stock markets continued to go up during my tenure of investing. I've had a favorable job market when I entered it. I'm healthy, I have lots of energy, and as well as a great support network and supportive family that I've had in my life at many key steps in the journey. So that's all stuff that worked heavily in my favor. And we can't deny the role that luck plays in our lives, but the goal is not to be trapped and reliant on it at the same time, because there are still ways out of situations that aren't ideal. And if you're watching this, you're from another country or you're from a non-supportive family, there's no way to cut it. It's going to be a tougher journey than the one I experienced, and I'm aware of that. But although it's harder, it's not impossible, because my path is something that can be followed. I went to school, I worked hard to get a job, and then I just invested with a lot of discipline, and I continually learned. And now that, I believe, is a path that most people can follow. So attending university is a huge financial decision. So we're going to start here. My goal was really to make college as cheap as possible, because this will affect your net worth. And for those in that phase of their lives, you need to be thinking about this, because college is an investment, and you need to think about what's the cost versus what can you estimate that you'll make afterwards. You might not even need college, and you should not be getting a bad ROI degree. But depending on you and your situation, it could be a good decision, and I'd say it was a good decision for me. So if you do decide to go, you need to ask yourself, how can you lower the cost of it and increase your chance at a good job afterwards? So here's how I did that. Let's start with high school. I know what you're thinking, Whylearn, what the hell did high school, how does that affect my net worth? Well, here's how. I did work some jobs, like minimum wage jobs in school, but that was just to keep the lights on. That wasn't really impactful. What did affect my cost was I loaded up on AP classes in high school, which gave me college credits. Like I was a turbo try-hard nerd in high school, and I own up to that. I went all out loading up on the most difficult classes I could for college credits. This is AP Comp Sci, this is AP Chemistry, Macro, Microeconomics, and more. And due to this, I basically attended college starting as a sophomore in 2015. I had 2 full-time student years, and then I was a part-time student my entire time as an upperclassman, and I graduated college in 3 years with a computer science degree in 2018. I went to a public in-state school, shout out to UW-Madison, with much lower tuition than a private or out-of-state school. And due to my test scores and grades, like I said, I took everything seriously back then. I did have some scholarship options, and there were a few good schools who had scholarship guarantees to those with my test scores and grades. And I considered that, but I loved Wisconsin too much. So my total tuition for the 3 years was around $30,000. So this is not very expensive, relatively speaking, due to my AP classes and just being a part-time student. I always had 1 or 2 jobs at a given time, in addition to starting a failed business. But I worked for Jimmy John's my freshman year. Then I worked for a small family company another year after that. And these are both part-time. We're talking $12 to $15 an hour. And then later in university, I got a higher paying job as a software development intern for a bigger company at $22 an hour. This allowed me to stay on top of my living expenses with money coming in. And then later in college, I was making solid money to cover everything. And I was working very hard. My grades really suffered towards the end of university because I was so busy with everything else I was doing. And to be honest, I just wasn't feeling any interest in my college classes anymore because I thought the job was much more interesting. I prioritized experience over grades, and I believe this helped me. So you should really try to get work experience in university to stand out from the crowd and command a higher salary when you start. So the next part I'm not going to hide from, and I'm sure people are going to jump at this to discredit every accomplishment that I have for my entire life. But I had great parents who helped me with the remaining cost of tuition that I couldn't cover myself. I simply followed the above steps to make it as easy as possible on them. If they weren't paying for some of it, I would have likely explored some of my cheaper options for university. But no matter what way we sliced it, I didn't want to come out of college with much, if any, debt. I graduated with no debt, essentially around a $0 net worth, and this was huge, as student debt is a big burden, and I'm not denying that this is an extremely advantaged position to begin my software career. So this takes me to my early career. I took a job at $75,000 per year as an entry-level software engineer that was offered to me after my internship, and I continued living with my college roommates. This is late 2018 to early 2020. This was when I dove into the world of investing at age 22. I read books. I read The Intelligent Investor and Unshakable. I got into YouTube videos, watched people like Graham Stephan, studied strategies of guys like Warren Buffett, and from there I began to open my accounts. I took advantage of the tax-advantaged accounts and company benefits as I was starting my company. In the United States, taxes can eat away at your gains, so any strategy you can use to legally, and an emphasis on that, legally pay less taxes is great. The government offers you these tax-advantaged accounts, so I fully used them. First step was I opened a Roth IRA and threw in a few hundred a month to start. And this is nice because the growth in this account is tax-free. So I loaded up as much as I could into this every year. And this is huge because the compounding effect for 40 plus years is massive when you don't have to pay taxes on the other side of it. I also opted into the company pension, which I would become vested in after 3 years of working there. I opened a company 401k, which had a match of up to 5%. Mainly in these accounts, I invested in very stable ETFs and mutual funds. I'm talking SPY, SEHD, VYM, VIG, VTTSX, and those kind of things. A 401k is nice because you don't have to pay taxes on the income going into it. Plus, I got a free match, so large amounts of money can compound over time, then you just pay taxes later. I would put in as much as I could into my investments at this time, which was a few thousand a month, and my rent was like $500 a month. I still lived with my roommates. I drove a really shit car. I drank cheap beer. I had a cheap lifestyle. Our apartment had a rat problem. There were homeless guys sleeping on our porch occasionally. Like, it wasn't great. My lifestyle was like a guy making minimum wage, even though I was making good money now, and that's the key. I also opened a taxable brokerage account to be able to play around with investing in individual stocks. So over this year and a half, the market went up and my net worth went from around 0 to 50K right before COVID. And I was on top of the world because at 23, this is a great position to be in. And I held a little bit of crypto as well, but never more than a few thousand. I got a promotion at work, and this was a little bit of a pay increase during this time as well. And these are good times. I was making money, and stocks only go up, right? Nope. Early 2020, the virus we all know hit the world, and most people lost about 30% of their net worth in a few weeks. This was scary because I lost a 5-figure amount on paper and I didn't know what to think. Losing 15,000 in a few days, or I guess a few weeks, was scary. And this is very similar to what's happening today, an aggressive crash in a short time period. I'm very thankful that I had good role models and investors in my life screaming at me what to do. But things will bounce back. Now is the time to be buying, is what they were telling me. So I doubled down on this. I moved back in with my parents during this time to save money. Every morning, my dad and I would wake up, we'd check the markets, then we'd go grind at our remote jobs, talk about what opportunities are out there, and our house felt like Wall Street for a little bit. It was kind of fun in a weird way. During this time, I doubled down on my investing. I sold stuff on eBay to get more into the markets, took it to an extreme level. I was maxing out my paycheck into the markets as much as I could. I was constantly reading quotes from famous investors like, buy when there's blood in the streets, be greedy when others are fearful. And everyone was panicking, and I just did the opposite of what everyone else was doing. And it was a rough month with lots of loss and uncertainty. But I had a few great buys during this time. I bought the Qs at 185, Blackstone at 36, VIG, low price, 401k mutual funds, much lower price. It was a crazy fire sale of everything. And my biggest buys were like mix of individual and ETFs. And again, I'm not sure I'd go with individual companies anymore, but I still hold a lot just due to my buying in this time period. And it's just because it's kind of fun too. So it didn't take very long, and my net worth basically exploded as the market bounced back in this V-shaped recovery. And I went from about a $35,000 net worth during like the worst part of COVID to $100,000 by the end of the year in 2020 as stocks came back aggressively. Then eventually, this all went all the way to 200K, which was when there was a local peak in the market in October of 2021. So looking back at this, COVID was a huge opportunity for me to buy a bunch of stocks at low prices. The S&P was super low, the Dow, the NASDAQ. This crash was actually a good thing, and controlling my emotions during this made me tens or even hundreds of thousands of dollars. In terms of my career, there's nothing else to do during this time of COVID, so I kept working very hard. Our team was becoming very important since we wrote code for the websites at the company that I was working at, moved to more of an online sales business model. And eventually I got promoted to a coveted senior engineer position, and this was the first time I ever cracked 6 figures of income in a year. And I still lived with my parents. You see the point here. The more I made, the more I kept my lifestyle the same. And this allowed me to continue to invest thousands of dollars per month with no big debt, no expensive lifestyle. That year I also bought a little bit better of a car, about $5,000, since my old one was really having a rough time in the Wisconsin winter. So rest in peace to my 2003 Saab. I took more advantage of the tax advantage accounts at this rate, and I was able to max out my 401k and my Roth IRA each year while living at home. I did some extra side hustle work of reselling NFL and NBA cards on eBay and at trade shows, and this added an extra few thousand of profit per year, and this was just something I enjoyed doing. Despite this, I thought I was becoming comfortable and stagnant and underpaid in my current job when I was looking at the job market at the time in 2021. Software engineer was booming at this time, and I knew I could get a better salary, and I was getting tired of living with my parents too. So I went on a job hunt. I switched jobs to a higher paying one. And by switching, I got about a 25 to 30% raise, just showing that switching jobs every few years can get you raises faster. And I even took a lower ranking engineer for this type of a raise, which was crazy. Now through this, I was able to scale my investments to about $4,000 a month. And I was in mostly safer things at this time, less individual stocks, although I still enjoyed playing that game too. This was a lot of work to get to this point, and I'm proud of myself for this time period because the math was saying that I was really in a winning position at this time. I opened my HSA, which I wish I did sooner because it's the only account with a triple tax benefit when used for medical expenses, which we all have. So look into that if it makes sense for you as well. I moved to a city, which elevated my cost of living a little bit, but I had a big cushion and it was well within my means at my new salary, so I was fine. I was making about 130K plus depending on bonuses, and this allowed me to max out nearly everything. 401k, putting as much as I could into a Roth, although I was getting close to that contribution limit at this point. And everything left over just went into a taxable brokerage account, which was easily becoming my biggest account at this point. Then, just like usual, the markets did not go up forever. And this wasn't really an aggressive crash, but a slow one due to the Ukraine war and inflation. So in 2022, the S&P dropped into bear market territory over a fairly long period of time. And this cost me about $30,000 plus. I remember going from over 200K to, I believe, 170K, 180K. Thankfully, this time, just like last time, I had the high income to weather the storm. Again, I was able to get massive deals here. One of my funnier wins was I actually interviewed at Palantir in 2021, and I completely bombed the interview, but I thought their software was really cool. So I got into Palantir around $6 a share, and look at it now. That's pretty lucky, and it was kind of a gamble too. But I also stuck with my dividend ETFs and some growth mixed in. A few big players like e-commerce giants from around the world I was investing in. I got more into my dividends because it was becoming bigger and more stable, and SCHD became my biggest ETF dividend holding. Eventually, per usual, it bounced back again. I quickly got back to 200 Gs, then I brushed past the 250K, 300K, 350K as the market continued just going up every year, 20% increase. So again, this crash helped me. I controlled my emotions and took a long-term view, and it rewarded me handsomely. So now let's talk about the 2023 to 2024 time period. And this was probably one of the most hard-working times of my life so far. So I got promoted again that year to a third-level software engineer, and I was able to save and invest even more. But I kind of lost myself in the work here. Like, this is where I was starting to realize extra money and just numbers going up on a screen isn't bringing me in any more happiness. I mean, I got money for more than what I need right now, and I'm kind of just feeling the burnout of the corporate grind. I really had my investment game at a high level. I was seeing quick net worth increases as well as great years for the S&P, but something was really missing in my life. And this was when I really started to think about starting a YouTube channel and getting into entrepreneurship. The problem was I didn't have much time, and I had some destructive thoughts in the back of my mind saying like, well, what am I going to do if I leave? Like, I don't know how to start a business. I've never succeeded in that. How am I going to do this? And my only other income was dividends at the time. So in January of 2024, I made the decision that I would quit my job later in the year to be with my girlfriend long term and chase my dreams of entrepreneurship. My plan included the following: moving back in with my parents again, and this was at 27 years old. So as you can imagine, I was making very good money, more than I ever have at over 140K at this point. And I was living with my parents with no other major bills. Again, this really freed up my investing. I was able to get my investments to 5,000 plus per month. And although I wasn't expecting much from it at the time, I started my YouTube channel in August of 2024 with pretty low expectations. But it was a nice creative outlet, and I was talking about stuff I wanted to. I enjoyed COD, I enjoyed finance, nostalgia, life topics. It was the perfect time looking back, given the beginning of the resurgence of COD commentaries. So, 2024 was really, I'd say, the pinnacle of my hard work. Like, I grinded my face off. I worked as a senior engineer during the day, then I used the money to invest, and I'd come home after being tired and make YouTube videos after work and on weekends. It was a grind, but it was worth it, and it was starting to pay off. My channel got monetized, and I started to bring in about $500 a month while I was still working. So now I had two income streams, and it was dividends and YouTube AdSense. I got to 10K subs before even leaving my job, and I also got to $500 to $600 a month in dividends before leaving. So I had over $1,000 plus in side income outside of my job, which is more than enough for me to travel and live in cheaper countries. And any other deficit I ran could be covered by my portfolio. So I picked a point to leave once I got vested in some company benefits. Then I told my boss that I'd be leaving to just do some traveling. I left on some good terms, and honestly, I have nothing bad to say about working for them. I just wanted something different in my life at the time. So getting much closer to present day now, traveling is something I always wanted to do. I always wanted to start a business and, of course, take the next steps in my relationship. So after quitting, I traveled to Colombia, lived there for a few months, grinded YouTube more, and now I have a trip to Portugal planned in the coming months. I'm not investing anywhere near as much as I used to, and I'm working on increasing my income. I'm in the 2 to 3K a month range at the moment, and I'm investing about 1,000 a month in markets, and I'm investing about 1,000 a month into the markets between dividends and my cash pile. And I'm going slightly negative most months, but I'm learning about entrepreneurship, and it's a work in progress. I'm hoping to be able to sustain my lifestyle wherever I am in the world by just growing my income streams and my net worth. Like, the beauty of compounding is still rewarding me, even though my income's not as high as it used to be. So now let's talk about the crash right now. First of all, we've had a lot of years of great gains in the markets, so we were kind of due for something, and the tariffs war just kind of took it over the edge. Now, the tariffs are very controversial, but I've learned that people also overreact to everything. Like, nobody would have sold as aggressively as they did in 2020 had they known the outcome that it was just going to come back in a couple months. In fact, you might not have even sold anything in the first place, because even if you invested in February of 2020 at the worst possible time, you'd be happy right now 5 years later after a few months of suffering. Because all it takes for this instance right now is like one good week or one good month of trade deals for the market to have some heavy green days. And or just one decision where the tariffs get paused. That could literally reverse a lot of this. So this could be the big reset the market needed. Again, I don't know what's going to happen, but what I do know is that the last two crashes before this got me into the financial situation I'm in today. So I'm going to, feel it out and see what happens. So let me just briefly summarize some of the mistakes I made, and I'm probably going to make a separate video for this, but I'd say number one, being smarter with my cash. Like I just would kind of leave, stuff in a checking account, not really earning a yield on anything. You can be smarter with putting your cash in better accounts. I still gambled on some risky stocks, and I lost a fair bit of money doing that a couple times. So I put most of my money towards safe stuff now. I also regret not opening an HSA sooner because there's so many tax benefits there, and you already know you're going to have health expenses. So I could have easily done this sooner, but now I'm fully prepared for any medical emergency. And it's basically like paying no taxes on income that you're just going to spend anyways. So I highly recommend looking into that. Another mistake I made is not starting sooner. Like when I first started working, I wish I even put $50, $100 a month into the markets, and I could have a lot of extra income right now. And I'd say the final thing, the mistake I made, is just assuming that money is going to bring you happiness, because it's not going to. The people in your life, the projects you're working on is what truly brings you fulfillment. So these are all things you should consider for your situation. Let me know kind of what mistakes you've made as well. But the goal for the future is to just figure out this entrepreneurship thing. I just want to break even and then eventually get to a point where I'm investing a lot again. For my lifetime, it would be nice to have a nice paid off house, a few million working for me in the markets, giving me nice dividends and enough income to support myself and a few kids, giving them the life and education they deserve. That's my long-term goal. That's the end of the video. I know it was a long one, but there's a lot to talk about here. If I can do this, you can too. Just let me know what you think if your journey is similar, and good luck out there, gentlemen. So this next video is for people who want to know what an investment portfolio looks like, the breakdown between accounts, how much money I keep in each account, and some of the reasons why. I believe that we all need to use our tax benefits and what's been given to us by the government to be able to maximize the money in our pocket. So I'm going to go over all of that in this video. Enjoy. Today we're going to do a full breakdown of my investment portfolio. I'm a 28-year-old guy from Wisconsin and accumulated a $400K investment portfolio. And as of this video, it's about $421,000. And the market's been up lately, so that's been cool to see, but it definitely fluctuates quite a bit. But today we're going to be focusing on what it's invested in, what tax advantaged accounts I used, what I'm preparing for, and my plan to become a millionaire by 35. I'm not making this to flex. I'm just making this to show you what your portfolio could look like as you enter these levels of net worth. This one's for all the finance nerds out there like myself. Welcome to Whylearn Wednesday. Let's go get it. I'm sure lots of people will say that, this portfolio is stupid. Why would you do that? And they might be right, because a lot of these accounts were offered to me and some of them were good decisions. I'd say most of them were, but some of them maybe weren't. I'm just learning like everybody else. Okay. So this is just what I have. Also, as a 28-year-old guy traveling, I'm optimizing for flexibility right now. And this is likely a very different situation than many who might have plans to buy a home soon or do something different. Like everybody's situation's different, right? I'm also a little bit paranoid about account security. So I like to have things distributed so that if one account's compromised, it's not a significant portion of my net worth. Like I don't like having it all in one place. I also like to optimize for tax advantaged accounts, and I'll discuss that in each section. Right now I'm doing this, but my goals will shift eventually once I stay in one place and have a family and do that kind of thing. So first off, let me start with some assets that I'm not counting towards my net worth. I have a paid off car that I paid for in cash, actually, valued around $4,000. I have a couple $1,000s in old collectible money and NFL and NBA trading cards. I have a lot of electronics, computers. I'm not counting this because they're not financial accounts and they're not very liquid. Like if you sell this stuff, you likely have to take a little bit of a discount, and some people do include this stuff in a net worth calculation. A lot of people do it as like a 30 to 50% markdown, and there's a lot of room for debate on the value of these, so I'm just not going to count these. This is going to focus on either financial accounts, retirement accounts, or very liquid assets. And we're going to talk about these in ascending order. So let's dive right into it. My first asset, and the smallest one of them all, and to be honest, a little bit of a mistake on my part, is what's called a cash balance pension, and this is $8,500, about 2% of my portfolio. So companies offering a pension nowadays is actually pretty rare. And somehow I got lucky and ended up working for 2 companies that actually offered them. And when you leave these companies, usually they give you a few options. You can keep it, you can take it as a lump sum, or you can take it as an annuity, which is just basically a monthly lifetime payment. For my most recent company, I ended up taking the cash lump sum. For this time, the prior company I worked for, I made a mistake. And the mistake was that I had a 90-day deadline to take it as a lump sum without a penalty. and I missed that deadline. So that would have been a good idea since pensions are in really conservative assets, usually a heavy bond mix. And I was so young that I didn't need to play it that safe. Like if you're young, investing in bonds maybe isn't so good of an idea. So I'm going to let this ride. It's a very conservative asset that's pretty much locked in until retirement, unless, of course, I want to pay the penalty. If a big crash happens, I might take the penalty and convert this to cash. So asset number 2, and I'm sure the crypto bros are going to really come after me for this one, is my crypto portfolio. This is about $9,000. Again, only about 2% of my entire portfolio. And I only hold on to the big guys, the Bitcoin, the Ethereum, and crypto's had a nice run up lately. And that's really cool to see. And I'm in this for a few reasons. I do believe mainstream adoption could drive more growth. I also believe many are using crypto as a hedge against future currency issues. There's a lot of uncertainty right now around the dollar and the world, and I believe a lot of it's overblown, which is why I'm putting my money where my mouth is. Like, I'm not getting super into the America's collapsing rabbit hole, but I do believe in the technology of crypto. I think the big question mark is what it evolves into and how it matures into the financial systems of the world. Because of the growth potential, I'm considering moving a little bit more money into crypto, but this will never be more than 5% of my portfolio. I'm cautious, it's still a new technology, and it's open to disruption in many ways, so still risky. Asset number 3, and this is one that I regret not starting sooner, is an HSA. This is a health savings account. And again, this is about 2.2% of my portfolio. This account is balanced with conservative Vanguard mutual funds and some cash. Now, here's why this account is huge for me, and especially if you live in America. We all know we're going to have health expenses. If not now, in the future, we will. And this is the only account that I'm aware of with a triple tax benefit. So you have no taxes on income going into it and no taxes on growth when you spend it on health expenses. My employer offered a match for this, so this was just a no-brainer for me. And once I understood how it works, I was kicking myself for not getting one sooner. The contributions here are heavily limited, and you need a certain type of health insurance plan to be able to have one. And I believe you can only contribute like $3,500 or $3,800. I'm not sure exactly, but it's essentially giving yourself another tax benefit. And I believe if you get to retirement age, you can just withdraw it like a traditional IRA. So what this gives me is peace of mind. If a medical expense or even a medical emergency happens, I have $9,300 in tax-free money to pay for it comfortably. Plus I have, obviously my health insurance plan on top of it. And this is invested in the stock market in Vanguard funds, so it will continue to grow with the stock market tax-free as long as I use it on health expenses. So to me, in my situation as an American, this was a no-brainer. Asset number 4, and this is a pure cheat code, my personal favorite, the Roth IRA. I have almost 47 grand sitting in here, and this is about 11.4% of my portfolio. This is a tax-advantaged account where you pay no tax on the asset growth. And that can make a huge difference because in America, taxes can eat away at your gains. Let's just give a super simple example. Let's say you have 100 grand in your 401k or some other investment, and you withdraw all of it in retirement. You're going to be paying taxes on that as if it's your income. Depending on where you live, could be 15, 20, all the way up to 30+%. And this is tens of thousands of dollars in taxes. But if you have this in a Roth, it's all yours. This is heavily limited by the government. If you reach a certain threshold of income, you can no longer contribute. Plus, the total contributions per year are heavily limited. I believe it's $7,000 a year right now. I'll double check that, but it's definitely limited. Anytime the government puts heavy limits on the accounts like this, it must be good, right? There was a few years where I couldn't contribute the full amount due to my income, but now that my income's lower as I'm an entrepreneur, I plan on ramping up the contributions here again. I'm thankful that I opened this right when I started working. I've contributed to this every year, sometimes maxing it out, sometimes not. And I also like having some dividend payers in here because you don't pay taxes on those. Plus, you can always withdraw what you put in. You just can't withdraw the investment growth without the penalty. Assuming steady growth, this will be lots of money for me in retirement tax-free. So I'm very excited about that. And in terms of my investments in this thing, it's very flexible and I'm doing mostly long-term ETFs. I'm talking QQQ, SCHD, SCHF for a little bit of international exposure, and then some Vanguard dividend funds. So asset number 5, the most liquid asset there is, this of course is cash. So this is basically cash that I keep in a variety of places. I keep about 46 grand in cash in my brokerage account where I can pull the trigger on investment opportunities that arise. I also have a checking account, Venmo, credit card points, which are very liquid, so I'm counting that. Then, of course, I always keep some physical cash with me as I travel, about $1,500, just for peace of mind or in case, something happens to my credit card. I get a small yield where I keep this cash, nothing crazy. I probably should have utilized a high yield savings account, and I'm still looking into options there. That was a mistake I made of not using cash in a smart way, especially if it's this much cash. And to me, this kind of tells a story about my investment philosophy. So about 15% of my total portfolio is in cash, 14.6%. So this means 85% of my portfolio is in non-cash things and non-cash investments. So that should tell you where my head's at. In my opinion, I don't think cash is a great thing to hold at scale for a long period of time. It's a tool. It decays in value, and it should only be used as a tool to buy things that appreciate in the future. Obviously, anything can happen. This is just my view on it. I'm happy with this percent of cash, and I'm a believer in America and the stock markets. So this is my next asset, and this is my second biggest one, the 401ks. And I say 401ks plural because I have two. I have two of them for each of the companies I worked at. This is about 23.4% of my portfolio and about 98 grand in total. These are in Vanguard mutual funds, what's called target date retirement funds, which basically means you're more exposed to stocks when you're younger, and then as you get older, it shifts into more conservative stuff like bonds as you get closer to retirement. There were years when I maxed out my 401k, and then years where I only went up to the company match. I utilize them heavily, and it's not a bad tool at all. I didn't combine these accounts mostly because they were both big, and I wanted to keep them separate, and I wanted to see which administrator and fee structure I like better, to be honest. So there's lots of discussion and debate around 401ks, oh, you're tying your money up, it's stupid, it's not flexible. I have a few comments and questions about this. Number one, do you plan on living to age 60 plus? If yes, okay, cool. You'll need money to spend. Now, would you rather pay more taxes or less taxes? If the answer is less taxes, well, great. With the 401k, you don't pay taxes on the money going into it, giving you larger amounts of money to compound over time. The compounding power is that you have more money up front. You're going to pay taxes later. You pay taxes on the back end in retirement. You can also contribute to both a Roth IRA and a 401k at the same time as long as you meet the requirements. Also, if your company has a match, which both of mine did, it's pretty silly to not at least take that match. Like many companies say, if you contribute 5% to your 401k, they'll also match 5%. Sometimes it's more, sometimes it's less. And that means that the moment you contribute that amount, you get a 100% return on your money that day. That's hard to beat. Now, it's very popular on social media to hate on 401ks as like a boring investment or even a scam. But here's the truth. Roughly 80 to 90% of American millionaires have used a 401k as part of their wealth building strategy. Dave Ramsey is a big advocate of it, and he studied about 10,000 US millionaires. He found that 80% of them reached millionaire status through an employer-sponsored retirement plan like a 401k. These millionaires often invested consistently, 20, 30 years, took advantage of employer matching, and stayed invested during downturns. This tells me that 401ks, they're not a scam. They're a very powerful wealth-building tool for regular people. You don't need to be an entrepreneur. You don't need to be a crypto wizard. The boring path, which is just investing early and consistently in index funds through a 401k, it still works, especially with compound growth and tax advantages. So I do have, about 25% of my portfolio in a 401k, and I think that was a good decision for me. So the final asset, and this one's the biggest asset by far, is about $187,000 invested in a mix of individual stocks and ETFs, and this is about 44.5% of my entire investment portfolio. This is just an individual taxable brokerage account, which means it gets no tax advantages, but it is very liquid. This became big for a few reasons. Number one, when I was in the peak of my saving and investing, you can only put so much into a Roth IRA and a 401k, so this account would often see 3 to 4k a month invested into it. Early on, I also took more risks. I picked some individual stock names. I had some that worked out really well for me, like Palantir and Blackstone, and I also took advantage of market downturns, investing heavily, usually from this account. But over time, I've rotated into more stable, long-term stuff, like dividend-paying ETFs like SCHD, VIG, VYM, and QQQ. I still hold a lot of the same stuff in the Roth that I do here. I still enjoy researching individual companies and occasionally making value investment plays, especially during downturns, but for the most part, I'm just dollar cost averaging and trying to keep it simple. This account gives me a lot of flexibility because unlike a Roth IRA or a 401k, I can sell assets at any time, pay the taxes, use the funds however I want, whether it's for travel, investing in my business, or big life stuff later on. And yep, because it's taxable, this is the reason that I don't get a refund most years, because dividends and capital gains are taxable events. I am enrolled in a dividend reinvestment plan, also known as DRIP, and I have it turned on for almost all my stocks that allow it, so any dividends I have automatically get reinvested. It's not flashy, it's pretty boring, but it builds wealth over time. Getting this account to where it is took a lot of discipline and years of regular contributions, mostly from my salary and bonuses when I worked full-time. And it's one of the most rewarding parts of my portfolio because it reflects like consistent effort. No windfalls, no luck, just investing what I could over and over again. And if you're just getting started, focus less on the perfect stock picks and more on building the habit of investing. This account started with just $500. So you can build something like this for yourself. It's just going to take time and discipline. So there you have it, all my assets, how I use them. I plan on continuing my monthly investments through dividend reinvestment, and then as my self-employment income stabilizes, I plan on contributing more and more. If I can manage to contribute just $2K a month, I'll be a millionaire at 35, assuming an 8% return. So I'm just going to shoot for that number aggressively, and even more if possible. So that's my goal. That's coming to the end of this video. Let me know what your investment goals are below. And as always, have a good one. Hope you enjoyed, and we'll see you in the next one. So this next video is my thoughts on dividends. Now, I love dividends as passive income because they're purely passive, like you literally have to do no work for dividends. However, you do need a big portfolio for dividends to, quote, make a difference, right? To get to a place where it's significant income for you. And I've gotten a lot of criticism for like, why are you so young? Why are you investing in dividends? And I think my overall answer is that when the markets are a little bit overvalued as they are now, dividend stocks tend to hold up well and drop less. And there's some data that shows that. So I do like having a combination of dividends and growth stocks, but if you want to learn more about dividend stocks, here's the video. Today we're going to talk about how to set up a printer that prints money from your basement. Nah, just kidding, that's illegal. But we're going to talk about the next best thing, the legal money printer, dividends. How can I leverage dividends to make passive income? Hey everyone, Whylearn here, and today for Whylearn Wednesday, we're getting back into the finance world and we're going to talk about dividend investing, the basics of it, and how you can use dividends to make a little bit extra money on the side. It took me some time to build, but I now have a dividend portfolio that generates me about $570 a month on average, and this is money for actually doing nothing. Doesn't matter if I work hard that month or if I completely slack off. Over the course of the year, I will get around $570 per month, more or less, no matter what happens. And I want this number to keep growing. I really like dividends because they're very hands-off compared to something like real estate. And once you put in the work of getting the money to buy the dividend-paying stock, you just sit back and collect the money. And if you hit a home run and get a few nice dividend stocks that appreciate and continue to pay, it's literally like having a money printer in the basement that's just printing around the clock no matter what you're doing. This is my favorite type of passive income. However, it wasn't so passive. It took me about 8 years to build, and this is not a get-rich-quick scheme, and in fact, it's really the opposite. It's not easy, but it makes your life easier later. I can't live off of this amount of money, but it's a nice complement to my other income streams. So how can one build an income stream like this for yourself? Let's get into it. Just a disclaimer too, this is not professional financial advice, just something I did that worked for me, and it may not work for everyone. So first of all, let's get into the quick question from the viewer that brings up an interesting point about dividends, then I'm going to dive into it. So here's the question. Hi Whylearn, huge fan of your channel, appreciate the advice you give. I binged your videos and found a lot of it useful. Thanks man, thanks for supporting the channel. I noticed you've talked a lot about dividend income, and I was hoping you could talk more about that. I have a lot of money in ETFs that get quarterly dividends, but they don't add up to much. I'm wondering if there's certain things to look for when buying a stock for the intention of dividend revenue, or if it's simply a matter of volume. Any advice greatly appreciated. So thanks for the question, Dan. I didn't dox you because there's probably like a million Dans in the world, but you bring up a good point that dividends don't add up to much, but I'll be addressing that throughout this video because it is a matter of volume and being in the game for a long time to maximize the amount of dividends you get. And although it does start off small, you'll find that it could grow to be big time later on. So let me give a personal example of one instance where I've succeeded using dividends. So here's a personal example of where I bought a stock and this really worked out in my favor, turning about $5,000 into $30,000 to show you the power of dividend investing and how this can make a huge difference for you. Like this was really one of my home runs. So in March of 2020, as we all know, the stock market was cooked, everything down like 30%, and people really thought the world could be ending. There was red everywhere in the stock market and opportunities to buy stocks at steep discounts. And so I saw a strong company, Blackstone, ticker BX, and although yes, they're controversial now, much more controversial now than they were back then, they were a financially strong company. And so I bought in for about $36 a share in March for around $5,000 total. Then I just waited. BX is now at about $180 per share, which and I've over 6x'd my money because the stock went up 5 times, plus my dividend payments this entire time. And not only that, but they've raised their dividend quite a bit in the meantime. So last year I made $600 the whole year just with Blackstone dividends. You take the dividend yield is around 2%. I have about 30,000 of this stock now. That's about $600 per year. Not only that, but here's the interesting part. I make 12% per year on my original investment of $5,000 plus the appreciation of the stock. Now I have $30,000 paying me per year. So this is a cheat code, and it can literally happen with the right mix of research and luck and consistently investing, especially during downturns. I mean, if I even get a few more home runs like this, it'll just set me up for life. So Dividends has forced me to take a long-term view, because why would I sell this asset? Because it's paying me solid money, it's worth a lot, and if I sold, I just have to pay taxes on the large gains. So this is kind of like me thinking of it as locking up an income stream. So next, let's get into the basics of dividend investing. So for this video, this will be mainly just dividends and dividend investing. So first, let's define what a dividend is. A dividend is a distribution of earnings, often quarterly, by a company to its shareholders in the form of cash or stock reinvestment. So essentially, you own stock in a company, something that you purchase through a broker like Schwab, Ameritrade, E-Trade, Robinhood, or something like that. And then they make revenue or they make a profit, and they give you a small part of that and pay you out. So you're now the shareholder, and they're working for you. Usually, the dividends are paid quarterly, semi-annually, or in some cases, I'd say much less common, one time a year. Now, a stock has a dividend yield. So let's take a look at McDonald's, for example. We got $280 per share, and the dividend yield's about 2.5%. So if you multiply 280 times 2.5%, that's what you can expect to make per year by holding that share of McDonald's stock, more or less. The dividend yield is just the dividend per share divided by the current share price. So if a stock's $100 and the dividend yield is 3%, you can expect to be paid out around $3 per year or less. So it doesn't sound like much, but at the end of the day, if you buy these stocks, they pay you just for owning them, just for being an investor and supporter in the company. $3 out of 100, yeah, like that doesn't sound very exciting, but stick with me here, because the power of growth and compound interest, it can make a big difference in the long term. So why is dividend investing so powerful? I'm going to give you a couple of charts. First of all, the S&P 500, the main index fund for the United States stock market, 75% of these returns have come from dividends in the last 40 or so years. And without dividend reinvestment, constantly taking the dividend payments and putting it back into the overall S&P 500, you'd have a lot less of a gain than you would otherwise. So dividend income is also much more stable than the overall stock market. So if you take a look at this chart, which is the S&P 500 dividend growth, which means the dividends the S&P gives off, it's only declined about 3 times in this 35-year span, which is incredible. And in fact, it grows usually at like 6.5% per year on average. So the income you make from dividends is also growing on top of these stocks that are growing. Another thing that makes dividend investing powerful is that you can enroll in a DRIP program, or dividend reinvestment program, which means that as you're paid these dividends, it automatically just goes back into buying the stock. This gives you steady income and enforces dollar cost averaging, which is good for good times, good for bad times, because your portfolio is going to bounce back faster if you're always pouring money into it. This is also a powerful retirement strategy, as many older people use dividend paying stocks that are stable as an extra income stream. Companies that pay dividends are usually more stable than ones who don't on average, because you need to be stable in order to sustain paying out a few percentage points of profit to shareholders. Dividends can also have various tax benefits. Like, for example, some companies will pay out qualified dividends, which are taxed at a lower rate than ordinary income. So now let's talk about dividends versus real estate as passive income. So real estate's another great way that many people make passive income, but I like dividends better for a couple reasons. First, I'll say if you hit a home run on a property, it will probably outperform dividends, because the value of the home goes up, and maybe you're renting it out and you have good tenant. But it is riskier, because many things can go wrong. You could get a bad tenant. For example, one of my buddies had a property and had an awful tenant, and the tenant actually got mad at him one day when he wanted to collect his rent, and he actually lit his garage on fire. So that's not very good. But with dividends, it's not super risky. It's still risky because it's the stock market, but you have no overhead, you have no tenants. You simply put in the work to get the money, and you sit back and watch. Now let's talk about how I built my portfolio and just how to get started. So in my early 20s, I opened a few accounts and made dividends from 3 different places. One of them was an individual taxable account, a Roth IRA, and a 401k. And this is just a combo of Vanguard, Schwab, E-Trade, Ameritrade, and you go into one of these platforms, and then you look for stocks that usually tells you the dividend yield right there. For me, I don't chase high yields. I kind of like in the 2 to 4% range, because if companies are giving away too much money, there's no room for growth. And you can look up dividend players for yourself and just try investing in a few. There's a group of companies known as the dividend aristocrats, which is stocks that have been stable and growing their dividends consistently over decades of time, as well as Vanguard funds that focus on dividends like VYM, VYG, and then a Schwab one I like is also SCHD. So I won't get too into it, but obviously, as you know, I've said many times, I was cheap, I had a good salary, and I consistently invested more and more over time into these safe companies. And a lot of these index funds that pay dividends are safe and stable companies that are growing strong. And as my portfolio was growing, so was my dividend income. So what I like about my dividends is it forced me into a long-term view. So you don't get paid dividends by constantly buying and selling and trading. You get paid dividends for just being a long-term investor. So if I were you and I wanted to get started into this, I would open one of these accounts and then, just dip your toes in the water. Buy a couple of dividend-paying stocks that are strong and show track records of success, and just watch the dividends pour in quarterly or semi-annually, and then add more as you see fit. So usually these companies, they'll pay out quarterly. They'll announce their dividend and the date it's paid, and then get the dividend and decide whether or not to keep or reinvest it. So dividends are never my entire portfolio, but just another piece of my overall strategy. And it's one of my biggest and one of my favorite because it does force me to be a patient investor. I did start very small. So think of if you only have maybe $5,000 and you want to invest in a stock with a 3% yield. That's about $150 a year, or a little over $11 per month. But if you keep growing and the market keeps going up, all of a sudden you'll have $50,000 paying you $1,500 a year. And then that's over $100 a month. That's a little more significant. And then when you get into the hundreds of thousands of dollars of a portfolio, you're talking about potentially thousands of dollars per month in dividends. And remember the investment chart. Even small amounts add up to lots over time. So if you can find a way to even get $100 per month in dividend income, it can work out very well for you. I know that's the main critique, is that dividends usually start small, but you need to have the small numbers to get to the bigger numbers at the end of the day. I started very small, but it slowly grew over time. And last year I made around $7,000 in the year on dividends. And so dividends do fluctuate. I had some good months, some bad months. My best month was around $1,100, and my lowest month in dividends was about $350. So it does fluctuate a lot, but at the end of the day, I found it to be pretty consistently around the mid 500s to closer to $600 per month. And if I stay on this path, I can eventually get to multiple $1,000s per month. And I think my goal would be $4,000 a month in dividends, which would, given my normal expenses, just make me job optional, barring any setbacks for the rest of my life. So this is the power of dividends, just little bits adding up to a lot over time. Now, dividends come with a lot of critiques. There's a lot of investors and very, very good investors who don't like dividends. So let's get into some of the common critiques. Number one is dividends can be cut. So just like anything else, stocks can go down. During bad times, companies will often need the extra money, and they'll stop paying shareholders by reducing the dividend. But this is usually temporary. So dividends can be cut and go down just like anything else. But as the chart I've showed you, that doesn't happen very often. So there's less risk with dividends than a lot of other investments like growth stocks, which means there's less upside. So you certainly won't get rich quick doing this. Dividend companies often don't have as aggressive of swings as growth stocks, which is good and bad. A company like Amazon, they're famous for not paying dividends, and they prefer growth. They prefer to reinvest their profits into the company as opposed to paying shareholders, which helps with research and things like that. So that's a valid argument. Another thing to consider is dividends do get taxed. So when you take a growth stock that's not paying you dividends, you don't pay taxes until you sell it. But with a dividend stock, you do have to pay taxes every year on that. So that's something to consider as well, and a critique. So in conclusion, it's not easy to get there, but over time, your dividends can grow into a large amount and give you monthly income along the way. And this is just my story with it. Eventually, I was able to get to a good amount of money per month, and I've had some successes, and it's definitely one of my most reliable income sources. So we're getting close to the end here. Here's the second last video, and this is the beauty of Coast Fire. And Coast Fire just basically means you've reached a point in your investment journey where your investments will now carry you to retirement. You don't have to contribute anything more. And reaching Coast Fire in your 20s is huge, because that means you can pivot into working on your passion projects. You don't need to go for a high salary anymore necessarily if you don't want to. So if you're interested in the financial independence retire early movement, this video is for you. Imagine buying back your life and your freedom so that you can do work that you actually care about, even if it pays less, because you already did the hard part. By age 27, I hit what's called Coast Fire, and that means that I never have to save for retirement again. I still work, but now I only work on things that I actually care about. And if I stopped investing today, I'd have millions waiting for me at retirement. And I'm just a normal guy. I went to school, I got a 9-to-5 job, I invested in stable, boring stocks, but I was diligent with my money throughout my 20s. And that's what Coast Fire gives you. It's an important level to pass to take a step forward in your journey to financial independence. Now, this doesn't mean that you can retire, but you can shift your focus into things you actually care about. For me, this gave me freedom and options in my later 20s to pursue my passions instead of a boring insurance job. So today I'm going to go through step by step how people can reach Coast Fire earlier in their lives, ideally before age 30. If you play your cards right in your 20s and make the right moves, you can really set yourself up for some nice freedom in your late 20s, your 30s, and beyond. And a lot of this is going to be concrete advice that you can try out today. And if you're in your early 20s especially, This is your cheat code, but if you're late to the game, there's still plenty of time to turn it around. You can realistically do this in 5 to 10 years, so we're going to walk through these tips and help you get to your number. Let's start with defining what Coast FIRE actually is. So Coast FIRE is a branch of the FIRE movement, which stands for Financial Independence, Retire Early. And I've been a big fan of this movement for a long time, especially in my early 20s. I would just binge these FIRE videos on YouTube. And the philosophy behind this is that you basically do two things starting as early as you can. You live as cheaply as you can, and then you invest the money. And then after some time, could be, 5, 10, 15 years, maybe you start to have a significant amount of money, and eventually you'd be able to withdraw, 3% or collect a dividend, and then you're considered free. Your investments can now pay for your cheap lifestyle. And Coast FIRE is a version of that. So that means that you've accumulated enough money to where the money itself will compound into millions in retirement without you adding any more, which means you can just kind of coast to retirement. You can do a more relaxing job. You did all the aggressive saving and investing, and now the compounding is working for you, and you can do something else with your work. You don't have to focus on investing a lot anymore. So that's the key here, is that once you reach this number, you can shift into lower paying or more flexible work, or do higher risk stuff, do something that you've dreamed of. FIRE has a few levels. Coast FIRE is one of the earlier ones. Then there's, full FIRE, which means you have full financial independence to stop working and retire. And then there's fat FIRE, which just means you've accumulated so much that you can basically live whatever life you want to. Of course, Coast FIRE is a huge first step, so we got to get there. That's what we're focusing on today. Mathematically, the FIRE movement is really just a math problem at the end of the day. So here's how you can calculate your Coast FIRE number and then eventually your FIRE number. You always need numbers with these types of things because you need a concrete goal in your head. You need a North Star to shoot for. First thing you need to calculate is your basic monthly expenses. Then you need to calculate your difference between your income and expenses. This will be the amount you invest every month. And again, you need to be making this gap as big as possible because this is just going to go into the markets and become money that works for you. Then we need to make some assumptions, right? That maybe your monthly expenses grow, your investments grow, inflation grows. And I use this website for this. This is not an ad. I've just found this to be a genuinely useful tool, the Wallet Burst Coast FIRE Calculator. What you can do is add in your current money, your retirement age, your current age, inflation, income required to live, all this stuff, and this will calculate what your Coast FIRE number is. For me, I like to assume like 5 to 6K a month in spending money. Then I go with pretty conservative stock market returns and inflation. You can play around with the numbers to get the number that you want to shoot for. So Coast FIRE is awesome for the following reasons. Number one, it helps you build the habit of being cheap, not relying on things for happiness. It forces you into the habit of saving and investing early in your life. But I'd say the main reason that Coast FIRE is awesome, and this is what I personally used this philosophy for, is that you can switch into something you want to do and break even just to go chase your dreams. So for me, I was working for a big insurance company. It was a high salary, but very boring. I wasn't very passionate about what I was working on. And I kind of thought to myself, I don't need to be making 12K a month anymore doing a job that's boring. I can now go switch and make 2 to 3K a month, but I'm doing something I enjoy now. I'm traveling, working on things like a YouTube. I'm doing my own software projects. And with this, I hope that eventually it'll pay off and I'll be able to earn more in the future. This has allowed me to take higher risks. Like this isn't something I could have been able to do without this cushion. And as long as I break even, I'm still going to have millions when I am retired. I no longer need to contribute to retirement. Of course, I want to, and I'm going to continue to, but I don't need to. And that's a very powerful thing to say. And I want everyone to get to a place where they can get to Coast FIRE and then eventually full FIRE. So let's lay out a roadmap for getting to Coast FIRE, because honestly, the earlier you start, the better it's going to turn out for you, for sure. So step one, acquire a skill that's going to pay well, teach you a lot, and allow you to learn and meet people. Focusing on income is the first part of this equation, because without a solid income, you're not going to be getting to your number, and you really can't get paid without a marketable skill. So you can learn the skills in multiple ways. You always have formal education, although this isn't as important as it once was. You can do trade schools, you can do boot camps, community colleges, even good old YouTube University. For me, I picked a cheap in-state school, got a comp sci degree, and learned a skill that pays the bills, which is coding. You don't need to get fancy. Just pick something you're okay at that you can put up with. If you like solving problems and reading documentation and don't like talking to people as much, something like engineering might be a good thing to pursue. But if you like people and you don't like sitting down and banging your head against the wall solving problems, something like sales or a business degree could suffice. And this might be controversial too, but I wouldn't chase passion right away. You want to learn a skill with high leverage, something that's going to earn you money, and chase things that's going to help you in the future. Again, it's just something to learn, not something you necessarily enjoy, something that pays the bills and gives you skills. You need income to succeed with Coast Fire. There's no way around it. And I only got to my number because I was a software engineer, which paid very well throughout my 20s. So step 2, please avoid unnecessary debt. Now, I understand that some debt is necessary, especially for school or an investment in education for some fields, and the house can be a good investment too, depending on your circumstances. Debt can also be used as a tool for investment, and I'm not talking about that. I'm talking about the bad, destructive kind of debt. Things to be careful of. Number 1, paying a lot for a bad degree is basically a death sentence for your financial independence journey. So don't do that. Make sure your degree has a high return on investment. You can make college as cheap as possible through in-state options, scholarships, part-time jobs, and stuff like that. Another one is a car. Don't ball out on a car. Don't take on a big loan. I would buy a cheap car that's reliable and buy it in cash. Also, getting into a mortgage way too soon can be a bad decision. I can't tell you how many people I've seen just overstretch themselves buying a house that they probably shouldn't be buying right now. That's something to stay away from till you're more stable. And it's also going to handicap your freedom potential if you have this payment that you can't get out of. Debt will just eat away at your investment potential and basically harm your ability to invest properly. So only take on debt if it's absolutely 100% necessary. I avoided debt like the plague, and it turned out very nicely for me. You can still build credit. You can still use credit cards smartly to build your credit score, but you don't need to take on major debt to build this score. That's a lie. I've only used credit cards and my credit score is almost 800. The next step, step 3, and it's pretty closely tied to step 2, is be cheap in general. Like, income's the first part, but if you make $150K a year, it doesn't mean anything if you can't save anything. So a couple things I did to be cheap in my 20s. I lived with my roommates. The times I lived with my parents, like my rent was very minimal most of the time. I never inflated my lifestyle. I wasn't buying dumb things just to make myself look cool. Especially when you're young, you kind of have the pass for being cheap. So there's no need to buy stuff like that. Also, some sneaky things that could harm you is alcohol, obviously from a physical perspective and a money perspective. Subscriptions, overpriced meals, eating out. These are things you can cut today and really should have been cut yesterday. So definitely, have fun once in a while, but maintain a cheap lifestyle where necessary, because this will allow you to invest more, get you to your freedom sooner. Finally, and this is the big one, is take that difference between your income and your expenses and invest in long-term stable assets. So I'm not a financial advisor, but I am a guy who's saved and invested his way to over $400,000 in his 20s. So here are some of the strategies that I used. Number 1, I used tax-advantaged accounts wherever possible because taxes can eat away at your gains. I was a big fan of the 401ks, the company matches, the Roth IRA, the HSA. All that stuff was great for me. And then I also had an individual taxable account as well. I wasn't chasing get-rich-quick schemes. Every time I did, there was a higher chance I got burned as opposed to making money on it. So eventually I just turned fully into the long-term stable things. And I tell myself I don't buy a stock. I don't make an investment unless I plan on owning it for 5 years plus. Most of my stuff is in ETFs and mutual funds. I'm not gambling. I'm investing. I'm building a system that's paying me dividends and it's going to support me in the future. And this is huge. If you can get that 7 to 10% return on your money, you'd be surprised how much that can add up in 5 to 10 years, especially if you get yourself into a position where you can invest thousands per month. That's the ideal place to be. The next step, and this is kind of a bonus step, is starting side hustles. I regret not doing this sooner, and most people I talk to who eventually got into it regret not starting sooner. Like, I truly didn't start taking side hustles seriously until I was 27. Now I have freelance clients. Now I have a YouTube that makes money. I do consulting. So there's a lot of things that I wish I started sooner. I totally could have, and I just didn't. Instead, I stayed at home and scrolled on social media. So just the process of doing these things will not only teach you so much, but make you a better speaker and set yourself up for more stability if you have other sources of income. It's just a great thing to start to learn a lot. So I highly recommend starting your self-employment journey, maybe even before you're actually self-employed. In summary, the math will show you that if you get into a situation where you can invest thousands per month with a high-paying skill while maintaining a cheap lifestyle, you can get to your Coast Fire number within 5 to 10 years, right? The math shows that that will work out. Now, obviously, some people are heavy spenders, some people aren't. I'm probably on the cheaper end, but you need to have a plan once you reach Coast Fire of what you're going to do next. What are you passionate about? What do you want to make an impact? What fires you up to get you up in the morning? For me, it's projects I'm interested in. It's YouTube. It's making these videos, honestly. and use that money to chase your goals. And you're going to have limited time. It's not like you can just retire on the spot. But once you reach Coast Fire, you've bought your freedom for now. So congrats. But at the same time, the work is just starting. So just some final thoughts. I believe you can do this, but you have to start today. Get a financial plan put together for your life and start working towards building those skills, building those systems, getting income, and investing it. Coast Fire is just the beginning. It's a good number to shoot for, and the philosophy is honestly solid. Be cheap and invest in safe and stable things, but like don't take it too far as well. Remember to enjoy yourself. Buy experiences, don't buy things, and don't put money at the center of everything at the same time. But you can do this for your life. I'm rooting for you. I'm working here with you. So good luck, gentlemen. I'll be right here grinding in the trenches with you, and we'll catch you in the next one. So the final video of this series is my full goal for freedom and my vision for the future. So this covers kind of the 3 pillars that I'm going to be using personally to build my income. And I also cover the fact why I'm not after money. I'm more so into the freedom part. I want to spend my days how I choose, how I enjoy. I want to wake up when I want to, work on the things that I want to. And here's how I'm setting my life up for that. Lately, I've realized that I don't actually care about being rich. It's not about having a big house, a flashy lifestyle, or wearing fancy clothing. What I really want is freedom. That's always been the goal for me. So today I'm sharing what freedom actually means to me and the exact steps that I'm taking in my 20s and then eventually my 30s to unlock it and build a life that I don't need a vacation from. Since quitting my job, I've gotten a little bit of a taste of that freedom. And let me tell you, the feeling's unmatched. It's not fully there yet. I'm not really fully, broken free yet, but I see the path. So this is me, 28 years old, figuring life out, doing cool stuff, and chasing something bigger. And this is the vision for my life for the next 5 to 10 years and what I'll be building. For me, freedom is a complicated topic, and it means many different things to different people. So let me know in the comments what freedom means to you. But for me, this is what it means. When I wake up in the morning, my day is owned by me. I don't have to be at a place in a specific time. I don't have a daily commute. I set the schedule that I want to work. I work with the people I want to, and I work on projects that I own and that I have control over. I can go and have a coffee in the morning at the location of my choosing, and I can go for a workout midday and take a day off at my discretion without asking anyone for permission. And when I go out to eat or when I go shopping, I don't have to worry about prices. And I want to be free from these things. I want to be able to spend time with my future wife and kids without having to be away from them for extended periods of time. And I want to give them a great life and buy them cool experiences. That's my goal. And to me, the freedom part can sound a little bit arrogant, and maybe that's the American in me speaking, but man, it's like sometimes you just want to tell society to screw off. Like, I'm not doing what you expect of me. That's kind of what America was found on. Oh, you want to tax us? Screw off. We'll make our own country. In the last year, I've become obsessed with creating my own way, my own personal freedom, and fighting back against this system. I've taken many steps to work towards my own freedom. I'm 28 now, and throughout my 20s, one of the main reasons I am where I am now is because I was a serial saver and investor. I lived very cheaply, often with roommates or with my parents. I've invested a high salary for my software career, and I always stayed very flexible, like very low overhead, no mortgage, no car payment, no debts. And this gave me a nice cushion to have that first level of freedom, to where I was able to quit my job and go on some adventures and work on what I wanted to. Now I'm working on things that I care about, software projects that I'm interested in with people I like, and of course this YouTube channel as well. The freedom I'm getting from this is like pretty addicting, just in the beginning, but just to get a taste of this independence has been amazing. I've lived in 3 different countries since quitting. I don't have to get permission slips, no time off requests. I've been traveling with my girlfriend, who thankfully also has a remote friendly job, and I've met so many amazing people and starting to accomplish some cool things. I'm loving the new life so far, but don't get me wrong, it hasn't been easy, because since quitting, I feel like I'm actually working much harder now that I'm on my own terms. Like, I have more motivation too, because now I own the result of my project. I get paid as a direct result of the work I'm putting in. But the reality now is that if I stopped working, the money would dry up, and I'd eventually have to go back to getting a job and go back on the normal path. So my back's really against the wall with this, because if I fail, I have to go back. And after doing this, I don't know if I can go back, guys. Like, it's really something. So I have no other option but to figure this out. Which brings me to the irony of money and freedom. Most people say that they want the money, but I think what they really want is the freedom. The key is how you can make money doing things you can enjoy instead of things you don't enjoy. That's real freedom to me. And this is what I've really tried to hone in on lately. Like, we have to make money, so how can we at least make it a little bit enjoyable? In my life, I have 3 main ways that I make money. Software, I work on projects that I'm interested in now, and that's awesome, instead of being told what I need to work on. Also, YouTube. I've turned my passion for Call of Duty and talking about finance into something that's generating me, a couple thousand a month consistently now. And I've really learned that making money around your passions is more than possible. Like, it's not easy, it requires some work and a little bit of luck, but it's more than possible to do. And then, of course, I have my investment portfolio too, and I have a good deal of freedom that this has given me, like years of runway plus monthly income and dividends. And that wasn't easy to obtain either. This was 6, 7 years of hard work for me. Where I'm lucky in my life is that I never really derived personal satisfaction from buying things, right? Like, buying that one thing doesn't make me feel good. You know what does make me feel good? Having the option to buy it if I need to. Thankfully, being cheap has always come very naturally to me, and I have the money to buy nice things. They just don't do anything for me. I derive very little happiness from nice clothes, a new car, and stuff like that. My wardrobe's very simple. My life is too, because I'm traveling, I'm on the road. I can only bring so much with me at a given time, and I've learned to live with not that much. I have extremely low overhead. All I really need is a healthy body, good people in my life, an internet connection, and guidance for the man upstairs to do what I need to do to be happy. And when I go to bed at night, what makes me happy isn't the things I bought, it's the memories I had and the memories I made that day and the things I learned. Chasing Lambos and mansions is not a goal of mine. I'm not even remotely interested in that. I'm chasing autonomy. I don't want wealth for status. I want wealth for the options. Because when you have money, you have options. You don't have to listen to what society wants. You can just say no. You can tell them to screw off. Don't want to work at a job anymore? No problem. You can just quit. You don't want to take that deal? No problem. You got other deals. You don't have to take it. To become free, you need a strong foundation first. So what does this mean for you and I? Let's lay this out a little bit. The thing you need first of all is a skill. You need something that's going to pay the bills for you. For me, I can code very well. I've been paid the big bucks by many different people and companies for doing what I know how to do. And once you have a skill, you have to begin building a system that's working for you. This is one thing that pisses me off. Everybody's looking for shortcuts, the get-rich-quick schemes, the fast dopamine. They'll sell you the easy way, the quick answer. But the truth is, money's not easy. Nothing is easy. And those telling you that you can do something easy and become a millionaire in 1 year, they're probably trying to sell you something. And chasing fast wealth usually backfires. So I'm going to sell you actually on the slow way to gain wealth. And it's going to take years before you finally believe me, and that's fine. Because in 5 years, people are going to be asking me how I did this. If you don't build your life on a strong foundation, you're just doomed to fail. Your job isn't to get rich quick. It's to stay free forever. And that means building a foundation. It doesn't mean gambling. It doesn't mean relying on luck. It means building systems. I'm just beginning to build my systems using my skills, my voice, and my money to just keep compounding and multiplying. Most people will continue to just be idiots and chase the quick things and gamble. Meanwhile, I'm going to be in build mode for the next 6 to 10 years, building my systems and letting them compound. I want to build a financial fortress over my lifetime, and it's in progress. I've got a great head start, but it's going to take a lot of work. So I want to discuss the 3 pillars of strength when it comes to financial freedom and building my dream life, and here they are. And while you're listening to these, hopefully you can get some ideas of how you can build your dream life as well. Number 1 is you need a skill that pays the bills. And for me, this is coding, this is software engineering. You might not be super interested in it, but it's a high value skill. I want to have a few clients at a time to comfortably fund my lifestyle and help me continue my path to financial freedom. For you, this could be any high value skill that brings in money. Number 2 is my investments. I want to continue investing into my portfolio until it finally grows to 500 grand, 800 grand, then a million and beyond. And through this, I'll build more of a cushion as well as more monthly income. And finally, number 3, and possibly my most important one, is building the online brand Whylearn. I want this to be a beacon for people looking to figure out their 20s and figure out their lives. And I want this to be for impact, for purpose, to actually help people in their lives. And if this succeeds, not only does it have a big impact on others, but it gives me opportunities in the future to make the brand even stronger. These are the 3 things I'm building. And the cool thing about these is that these 3 income streams are basically uncorrelated with each other. Like in software engineering, there's a concept called having a single point of failure. So think of when you have a salary at your job and that's your only income. You're creating a single point of failure for yourself, because if something happens with your job, now you have no income. So with this strategy, I basically want to become a fortress of financial strength, one that gets stronger over time slowly. So if one of these goes down, let's say I lose a client, let's say the market crashes, I still have the others that are going to be continuing to make me income. So this is going to make me very resistant to hard times. Once I get these fired up and working for me, it will buy me the life I want, little by little, constantly, quietly, just building until it hits escape velocity. And if each of these is big enough to support me on my own, then it's game over. Then I won the game. And in 6 to 10 years, while people are chasing the next hack, I'll be living the life that I designed. Financial freedom, traveling when I want to, raising kids with lots of opportunities, freedom to create, freedom to just exist if I don't want to work. Let's say 10 years goes by. Now I have a YouTube channel with 200K subscribers. It's generating 8K a month. By then, my investment portfolio over $1 million, generating me 4K a month in dividends. Zero work done by me on that. Then maybe I have a software business too, where I have 1 to 2 good clients that enable me to stay sharp and continue working on interesting technology. I want to speak this into my existence. These are my goals in the next 5 to 10 years. And then obviously, eventually I could scale out, maybe hire on some people to help with content or other developers just to buy more of my time back. Then I could spend each day as I want to. Maybe I wake up, maybe I make a video, send it over to my team, write some cool software, look at the latest industry trends, and then, work for 6-7 hours on stuff I enjoy. Then spend the rest of the time with my family. I don't have to go to a job I don't care about. This is a life that's totally designed very carefully and strategically by me. And that's all because I started to build my freedom step by step. I used to be a rule follower, like a good student. I always tried to get good grades, a good employee. Now I'm writing my own rules, and I'm in the trenches. I'm working very hard, like much harder than I ever have in my life. And 3 years of pain is what I tell myself. 3 years of building this thing brick by brick, grinding out the long hours, the slow grinds. But after that, I think I've got a good shot. I won't be super rich, I won't be flashy, but I'll be free, and that's all I've ever wanted. And through this exercise of building all this stuff, I'll have acquired so many skills along the way that it'll just compound in the future and continue to bring me more opportunities. We can all construct the life of our dreams, gentlemen, but it really starts today. So let's get going together. Let's start now. Hope you enjoyed this one. We'll see you in the next one. So that concludes this video, the longest video in Whylearn history by quite a bit. If you've made it this far, it means the world to me. Thank you so much for your support on the channel. I've got a lot of good stuff planned for the next few months, and thank you for allowing this to be a little bit of a filler video, but definitely a lot of good stuff here. Thanks for watching, and we'll catch you in the next one.